A very happy morning, happy afternoon, happy evening based on what time you're watching this video, friends. Friends, now let us focus on all the amendments in your GST which are relevant for your November 2023 exams. Basically, this time we have discussed the amendment chapter wise. You'll find amendments for each of the chapters separately coming. So there are around 10 or 11 chapters in which amendments are there, and you'll find it chapter wise. So it is different from the last time update of amendments. And what all amendments we are going to see? Amendments which has come from your 1st of November 2022 till 30th of April 2023. They are given. And for ease of understanding, you'll always find, like always, the old provisions will be normally given in blue color, and the amendment portion will be always given in red color, so that you can easily identify and see what was the provision before the amendment and what is the provision after the amendments. And for your November 2023, the amendments are very limited. So if you see, the total amendments per se will not be more. It will be very limited amendments. So if you have already done your lectures, whether of our classes, Vishal Jain and Praveen Jain classes, VJPG Education, Vidyapeeth, or some other faculty, no need to worry. All you have to focus is on the amendments. If you are very clear with the concepts, there's absolutely no need that you have to revisit the concepts again. So if you have already prepared for your May 23 exams, updated thoroughly with all the provisions there, then what you can do, just watch this amendment video, only see the limited amendments. You'll find amendments very small portion. Rather, the major portion of the amendments that we are going to discuss contains circulars, clarifications, and very less amendment in the sections and the rules. Very limited amendments this time. Right, so let us discuss each of the amendment. This time we'll discuss it chapter wise. Yes, friends, now let us move on to your CBIC circular on no claim bonus, which is given by the insurance company. To understand this circular, let us first understand what exactly is no claim bonus. The moment we understand that, we'll be understanding both the parts of the circular. Basically, the circular is given in two parts. The first part of the circular deals with the concept of supply, and the second part basically is dealing with this chapter, which is valuation. Now, what is exactly happening? Supposing I'm the person who's taking motor vehicle insurance for my vehicle. So the insurance company is supplying me the services for my motor vehicle insurance. So there is a supply by the insurance company to me, and for which I am paying consideration. So there is a supply, that is insurance services by the insurance company. This is the supply for which I am paying premium to the insurance company, which is nothing but the consideration for that supply. Let us assume that insurance premium amounts to rupees 10,000, obviously plus GST. This 10,000 is the consideration. 10,000 is the consideration. Now, obviously, insurance company will be giving me invoice for this transaction. To be very specific, tax invoice for this transaction. Whenever there is a supply, there is a tax invoice. So this is happening, let us assume, for all the first 4 years, first year, second year, third year, and the fourth year. In the fifth year, the same thing is happening, that this insurance company is giving me the services of insurance for my motor vehicles. Basically, we had taken the example where the insurance is for motor vehicles. So there is an insurance service which is supply, and in return I have to pay the premium. Basically, I'm talking about the same thing that we have discussed now, but this time I'm talking about the fifth year. In the fifth year, also the insurance amount that I have to pay is 10,000 for the fifth year as well. But in the fifth year, there is something else which is happening. Now understand that the insurance company is going to give it no claim bonus. because in the first 4 years, I have not made any claim, not made any insurance claim. Because of the fact that I have not made any insurance claim, and initially when I am paying the premium, I have selected for no claim bonus. What is happening? Now, this insurance company is going to pay me, this no claim bonus. It is going to pay me this no claim bonus. This no claim bonus will be in form of deduction from my premium. Supposing this no claim bonus is 3,000, this will be in form of my deduction from my premium, which means that in the 5th year, when I'm paying this premium of 10,000, there will be a deduction, and final amount that I'm going to pay is 7,000. Final amount that I'm going to pay is 7,000. So basically the question which was put in front of CBIC was whether this no claim bonus, which is paid for what purposes? Which is paid because I have not made any insurance claim. I've refrained from making any insurance claim in the initial 4 years. Can it be called as supply? Can this be called as supply by me, that is by the person who has taken insurance, to the insurance company? So basically the first question is, can it be called as supply? Supply by whom? Supply by the person who has taken insurance, that is insured, to the insurance company. The answer to this is no. It cannot be called as supply. For a very simple reason. I was not under any obligation. I was not under any contractual obligation for not making this insurance claim. The fact is, I did not make an insurance claim is different, for which I am getting a reward or incentive. So this had no contractual obligation. There is no contractual obligation for not making any insurance claim. Assume that in the first 4 years, there was accident of my motor vehicle, I would have made an insurance claim. Now the fact is, I have not made any insurance claim. Therefore, there is a reward which is given by the insurance company to me. I did not supply any services to the insurance company. There was no supply at all. Because this no claim bonus cannot be called as consideration for refraining from making insurance claim, because there was no contractual obligation for not making any insurance claim. So I cannot call this no claim bonus as a consideration that is paid by the insurance company to me, because it cannot be said that I refrained. There was a supply of refraining from an activity. Please understand that refraining from an activity is also supply. But you cannot by any imagination tell that refraining from making an insurance claim was must. If at all there was any accident of a motor vehicle, I would have claimed that insurance claim. So there is no supply. There is no supply at all. Absolutely there is no supply. The reason is, I was not under any contractual obligation not to make that insurance claim. Therefore, refraining from making insurance claim cannot be called as supply, because there is no contractual obligation, and the amount that I get in return, not in form of getting the amount but in form of deduction from premium, cannot be called as consideration. So this no claim bonus is not supply made by the insured, that is myself in this case, to the insurance company. It is not supply. The second question which is that, this is basically the first part of the circular. The second question which is that, can it be treated as discount from value of services supplied by the insurance company to the person who has taken insurance? Can this be called as discount from value? And the answer to that is yes. It can clearly be called as discount from value of services supplied by insurance company to the person who has taken insurance for a very simple reason. First, let us understand that this discount is post supply discount, and for post supply discount basically there are three conditions. There should be an agreement at the time of supply. Yes, if you see the agreement in the beginning itself, there was a clear cut, there will be clear cut discussion about no claim business. So there is an agreement, at the time of supply. And credit note, for this particular document the insurance company will be giving credit note. So credit note will be linked with this tax invoice. So this credit note that is there, is linked with the tax invoice. And finally, recipient has to reverse proportionate ITC. Insurance company can reverse output tax on this 3,000, and against which the recipient has to reverse proportionate ITC. So all these three conditions are satisfied. See, what will happen in the fifth year is basically insurance company will pay GST on 10,000, the fifth year premium. At the same time, it will reverse output tax, reverse GST on this no claim bonus, because it is nothing but your post supply discount, where there was a clear cut agreement at the time of supply. No claim bonus was clearly there in the beginning. And this credit note which is given now is linked with your tax invoice which are made in the initial 4 years, and the recipient will be reversing proportionate ITC. As a supplier, insurance company is reversing output tax on 3,000. The recipient, the person who has taken insurance, in this case VJ, will reverse proportionate ITC. So this is all about the circular, talking about supply in the first part and valuation in the second part. Yes friends, now let us discuss about your amendments in exemption notification and your amendment in RCM notification. First, let us focus on your amendments in exemption notification, which is 12/2017 CT rate read along with notification 9/2017 IT rate. The first of the amendment which has come out is in your education sector, where there is an explanation attached. So you already have a few explanations there in entry 66, which is about education sector. Now you have one more explanation, which is explanation 4A2 entry 66, which tells that for the removal of doubts, it is hereby clarified that any authority, board or body set up by central government or state government, including national testing agency, which is for the purpose of conduct of entrance examination for admission into education institution, shall be treated as education institution. But it shall be treated as education institution for the very limited purpose, only and only for the purpose of conduct of entrance examination for admission into education institution. Friends, for this you need to understand that there are three types of educational institution. One, category A educational institution. Second is category B educational institution. Third is category C educational institution. So category A educational institution basically talks about education up to higher secondary school or equivalent. Category B talks about educational institution for conduct of examination for getting a degree, which is for getting a qualification which is recognized by law for the time being in force. So category B is basically educational institution for getting a qualification which is recognized by law for the time being in force. And last is approved vocational skill development courses. So approved vocational courses, skill development, basically skill development courses. And when you see these three educational institutions, you need to understand this is basically educational institution. We can call it as category A, educational institution category B, educational institution category C. And it has already been clarified that when you talk about these educational institutions, even conduct of examination by these educational institution is exempted. Even conduct of examination by all these three educational institutions, whether it's category A, category B, category C, is exempted. Now, what is being clarified is If at all you're talking about conduct of examination by central government, state government, including national testing agency, for getting admissions into these three education institutions, for getting admissions into these three educational institutions. So who's conducting the examination now? Conduct of examination is by central government or state government, including national testing agency, for getting admission into either category A educational institution or category B educational institution or category C educational institution. For the limited purpose of conduct of examination, this central government authority or board will also be treated as educational institution, but only for the limited purpose of conduct of examination. So now if you're talking about getting admission, if at all you're talking about getting admission, and for which there is conduct of examination by the educational institution themselves, even then it is exempt. If the conduct of examination is not by educational institution, if it is by an authority or board set up by central government, state government, including national testing agency, even that is exempt for the limited purpose of conduct of examination. So basically there are three educational institutions, category A, category B, category C. When you are taking education in them, that is exempt. Even conduct of examination by them for entry, that is exempt. So that was already clarified. Now what is the new addition? Conduct of examination by government, central government or state government, including national testing agency, for getting admission to any of these three educational institutions, that is also exempt, and for the limited purpose of conducting the examination for the admission into these three education institutions, this also will be treated as education institution and there will be exemption. So that is the new change that has come in educational services effective from 28th of February 2023. Now the second amendment which has come here is, it is there in your renting of immovable property services. So basically we have already discussed last time that when you're talking about your renting of immovable property, so renting of residential dwelling for use as residence is exempt, but if it is given to a registered person, it is not exempt. So basically, first let us understand what is that exemption to understand what is this explanation. Now if at all I am talking about renting of residential dwelling, so if it is used for residence, if it is not used for residence, so basically if it is renting of residential dwelling, you have to ask a question whether it is used for residence or not used for residence. If it is not used for residence, clear cut it is taxable under FCM, whether the recipient is registered or unregistered, it is taxable under FCM. But in case if it is renting of residential dwelling used for residence, then you have to ask another question whether the recipient is unregistered person or whether the recipient is registered person. If the recipient is unregistered person renting of residential dwelling for use as residence, and if the recipient is not registered, that is exemption, there is no GST. And if it is renting of residential dwelling for use as residence, but the recipient is registered, there is GST under RCM. So basically the entry is, if at all you are talking about renting of residential dwelling used for residence and the recipient is not registered, it is exempt. But if it is renting of residential dwelling for usage for residence, but if the recipient is registered, it is taxable under RCM. Now there is an explanation attached here. Assume that this recipient happens to be a proprietorship concern. assume that this recipient happens to be a proprietorship concern. Now they are clarifying that this recipient who's registered as a proprietorship concern is taking two properties on rent. One there is residential house on rent used by his family. One there is a guest house by the proprietorship concern used for the vendors or the customers, etc., etc. So now this explanation tells that if at all you are talking about a proprietorship concern where it has taken two properties on rent, one is rent for the purpose of his own house for personal purposes, then they are clarifying that this will still be exempt. This will still be exempt, though this proprietorship concern is registered. This will be still be exempt, and only renting of the guest house for the usage of for the purpose of usage of the vendors or the customers, which means business purposes, that will be taxable under RCM, for the simple reason that this has got nothing to do with business, personal purposes, and this is for business purposes. So what is the explanation talking about? If at all, this issue will only come with the registered proprietorship concern. So if at all the recipient is registered and the recipient is registered proprietorship concern, now it has taken two properties on rent. The first property which is taken on rent is his residential house, which is used by his family. It is purely for personal purposes. It will still be exempt, irrespective of the fact that this proprietorship concern is exempt, because this basically will not be claimed as business expenses. It will go to drawings. Other is renting of a guest house for the customers, vendors, etc., which is purely for business purposes. This will be taxable under RCM. So the explanation portion tells that if at all you're talking about registered proprietorship concern, and it is taking immovable property on rent, but purely for personal use, it will still remain exempt. So if you now look at the explanation for the purpose of this exemption, which is explanation to entry 12. Entry 12 talks about this exemption. This entry shall cover services by way of renting of residential dwelling to a registered person, where the registered person is a proprietor of a proprietorship concern and rents the residential dwelling in his personal capacity, not for the business purposes, in his personal capacity for his own residence for the usage of by his family. And such residence renting is not on account of proprietorship concern. It is on his own account, not on account of his proprietorship concern. So it means that basically it is for personal purposes. Therefore, GST still will be exempt, though it is a registered proprietorship concern. And if it is for business purposes, claimed as business expenses, if at all that particular renting of residential dwelling, it is for business purposes. Say for example, you're talking about guest house to be used by customers, vendors, and all. Then there will be GST under that too under RCM. So that is the objective served by this explanation to entry 12, which is again effective from your 1st of January 2023. So this is the first amendment that we have seen in your educational sector. Second amendment is there into your renting of residential dwelling, that is renting of immovable property. And the third amendment, there's a removal of an exemption where you're talking about access to roads or bridges. Entry 23A is now deleted. So entry by way of access to roads or bridges on payment of annuity, if at all it is a lump sum amount on payment of annuity, now this has been made taxable. Again, initially it was taxable, then in between it was exempt, now it has been made taxable again. Basically, you're talking about access to roads and bridges. So if you're talking about access to roads and bridges, if it is on payment of toll charges, normal. So daily you go and access the road and bridges, and daily you're paying that toll charges, that still remains exempt. But if you're going daily and you're not paying toll charges regularly on daily basis, you're paying on a lump sum basis as an annuity. So this access to road bridges on payment of toll charges still remains exempt. Access to road and bridges by way of payment, by way of annuity lump sum payment, now it is taxable. Access to road bridges where the payment is by way of annuity, a lump sum payment, now it has become taxable. So that is your entry 23. So basically these three are the changes in the exemption notification, and the fourth one basically is a circular. So if you see the circular, the question of the circular is pretty simple: whether GST is payable on accommodation services which is given to air, which is supplied by the Air Force mess to its own personnel. Accommodation services by Air Force to their own personnel. Now understand that when you see the exemption notification where the services are given by government, it covers that services by central government or state government or union territory or local authority to any person other than business entities is exempted. Obviously, there are few services given by government, whether it is to business entity or non-business entity is taxable, like your postal services, transportation of goods, passengers. But other than that, if at all government is giving services to any person other than business entities, which is to not for business, profession, industry or commerce. So you're talking about giving services by government to any person other than business entities, that is exempt. There are few exceptions like postal services, transportation and all, but generally it is exempt. Now understand that when you're talking about accommodation services which is provided by Air Force mess or similar mess, like your army mess, navy mess, paramilitary or police forces, to their personnel or any person, is covered by this exemption notification as it is not giving to a business entity, is giving to a person other than business entity. The only criteria is the supplier should fit into the shoes of your central government, state government, union territory or local authority. So in this example, when the services are given by Air Force mess, or it is given by your army mess or navy mess, or it is given by paramilitary forces mess or police forces, it shall remain exempted, because when they are giving the services to their own personnel, any kind of services, basically whether it is accommodation service or whether it is any services given by all these forces, whether Air Force or your army or your navy or your police or your paramilitary forces, to their personnel is exempt, because when they are giving to their services to their own personnel, they are non-business entity, it is exempt. The only thing is the supplier should be qualifying as government. So that is the clarification given by this circular. Now talking about one amendment in your reverse charge notification. So we have discussed about your amendments in your exemption notification, 3 amendments and a circular. Now we are talking about an amendment in reverse charge notification, basically, which is notification number 13 bar 2017 CT rate read along with 10 bar 2017 IT rate. There is an explanation added, or there was already an explanation. Now there is a change to that explanation. The entire RCM exemption or RCM notification said that for the purpose of the entire notification, central government, state government shall include parliament, state legislation. This was already attached. Now they have further extended and said that for the purpose of your RCM notification, your central government, state government, whereas because generally services given by government is covered by RCM. Not all services, Mostly, if at all it is accessible, majority of the services given by government is covered by RCM. Now, it was already clarified earlier that central government, state government includes parliament, state legislature. Now, it has been further clarified that your central government, state government not only includes your parliament and state legislature, but also courts and tribunals, which basically means that whether the service is by central government or state government or parliament or state legislature or court or tribunal, when they are giving the services, normally it will be covered by RCM. Not always, but normally it is covered by RCM. So be it central government, state government, basically the notification talks about central government, state government, but it was later extended to parliament, state legislature. Now it is even extended to court, tribunal, when they are giving the services covered under RCM notification. RCM notification will be there not only for your central government, state government, but also for your parliament, state legislature, and also your court and tribunals. That is the effect of amendment in your RCM notification 13/2017 CT rate read along with 10/2017 IT rate. This amendment is effective from your 28th of Feb 2023. Yes, friends, now let us talk about your amendments in your registration chapter. Now, the first amendment which is there in your registration chapter is in your Rule 8 of CGST rules, which basically talks about application for your registration. Now, what used to happen is when you are applying for registration, the basic application form is Form GST REG01. In that form, there is the first part which is called as Part A. So in Part A of Form GST REG01, you are required to basically give 4 details, which is your PAN number, mobile number, mail ID, and the state and union territory in which you are going to take the registration. So your PAN was the first thing, mobile number is the second thing, mail ID is the third thing, and fourth is the state or union territory in which you are going to take the registration. What have they done is, they have removed your mobile number and mail ID. Now, one may wonder why they are not taking your mobile number and mail ID in your Part A of GST REG01. Why is because when you talk about your PAN now, in your PAN number, you would have automatically given your mobile number and mail ID in your income tax database. So now you will be giving only and only your PAN number and state or union territory in which you are applying for registration. So when you are applying for registration, your OTP will now go to mobile number and mail ID which is linked to your PAN. So you cannot give any other mobile number, mail ID. So there is no option to give any other mobile number and mail ID. Earlier, what you would have done is you would have given any mobile number, mail ID. Now, the moment you give your PAN, at the back end of the income tax database, your PAN will have a mobile number and mail ID. So one-time password will go to the mobile number and mail ID which is linked to your income tax PAN, not to any other mobile number, mail ID. So that is the basic amendment which has been brought to. So this PAN will be validated online from the CBDT database, and one-time password will go to mobile number and mail ID which is linked to that PAN number, not to any other mobile number or mail ID. So basically, this is the amendment which is brought in your Rule 8 of CGST rules, effective from 26th of December 2022. Going on to the other amendments in registration, basically in the same Rule 8 is there in your Rule 8(4)(a), where you're talking about application for registration, and the continuation of that is also there in Rule 9(1) and 9(2) of your CGST rules, which is basically verification by officer. So now the next amendment, which is an amendment linked to both Rule 8 and Rule 9. So that's the next amendment. They have made changes, or they have changed your Rule 8(4)(a) to include one thing. So when you're talking about your Part B of GST REG 01, basically there were three categories earlier. Three categories. Basically, even you can call it as four categories. Now that has been subcategorized into. So now to understand what has happened both in your Rule 8(4)(a) read along with Rule 9(1), 9(2), let us understand with the help of a chart. Basically, when you apply for registration, you have to authenticate your Aadhaar. It's not mandatory, but you have to authenticate your Aadhaar. If you don't authenticate, something else will happen. So basically, you're going for Aadhaar authentication. Either you're opting for Aadhaar authentication and it is successful, or you're opting for Aadhaar authentication but it is not successful, it is failed, or you're talking about you're not at all opting for Aadhaar authentication. Finally, you're exempted from Aadhaar authentication. So there are certain notified persons, including the Department of Central Government, State Government, or local authority, or your public sector undertakings, even when you're talking about non-citizens of India, and even for your unique identification. But for all these categories, they are exempt from Aadhaar authentication. Now, earlier, when you don't opt for Aadhaar authentication or Aadhaar authentication has failed, what was there is physical verification is mandatory. Physical verification of premises. Physical verification of premises is mandatory. Physical verification of premises is mandatory. But in the other two cases, there is no mandate of physical verification of premises. But what has happened now after amendment is, even if Aadhaar authentication is opted for and is successful, now it is categorized into two. One, you're talking about non-risky category, and one you're talking about risky category. So now, non-risky category and risky category. So if you look at the BAR Act wordings, the common portal will identify based on data analysis and risk parameters whether it is risky category or non-risky category. If at all it happens to be risky category, then there will be mandatory physical verification. Physical verification of the premises will be mandatory. Also, the fact that there will be biometric verification. Biometric verification. So if you see for this risky category, there will be biometric based Aadhaar authentication. So biometric verification will be there. And what will happen in this biometric based Aadhaar authentication is that you have to give the photographs either of the individual himself or of such individual. Say for example, for partnership firm, it will be of partners. For a company, it will be of directors. So that photographs has to be given even if the applicant is not an individual. Say for example, it is a partnership firm, photographs of partners. Company, photographs of directors needs to be given. And original copy of the documents which were uploaded in Part B of GST REG 01 will be verified at facilitation centers, which is notified by the commissioner. So what will happen in this risky category is there will be the biometric based Aadhaar authentication. That will be your biometric based Aadhaar authentication. Now what will happen in biometric based Aadhaar authentication? At facilitation centers notified by the commissioners, first there will be biometric verification of your eye retina or thumb scan, plus at that place you have to give the photographs as discussed if it is proprietorship concern, individual if it is a partnership form of partners, company of directors, and so on. And there'll be verification of original documents that you have submitted. Say for example, for the premises you have submitted lease deed. At the facilitation center, you have to go and give the original lease deed. Show the original, rather than telling that give the lease deed, you have to show that lease deed. So in this risky category, what will happen is there is biometric based Aadhaar authentication. What is there in biometric based Aadhaar authentication? At the facilitation center notified by the commissioner, you have to go. You have to go with biometric based Aadhaar authentication where eye retina scan may be there, fingerprint scan may be there. You have to submit the photographs and you have to show the original documents of what all documents you have submitted in Part B of GST REG 01. Right, so this is a new amendment that has come in, and as of now this biometric based Aadhaar authentication is on trial basis, and as of now it is there only and only in the state of Gujarat. So this biometric based Aadhaar authentication is not there in any of the state throughout India except for Gujarat. So as of now you have this biometric based Aadhaar authentication only in Gujarat. So what is changed is when you're talking about opting for Aadhaar authentication, now you have two categories. One, not a risky category, other a risky category. And in risky category, there will be physical verification of premises. Now basically, there are three places where you'll have physical verification of premises. Where you have opted for Aadhaar authentication, but it is risky, physical verification of premises is mandatory. Where you have opted for Aadhaar authentication, but it has failed, physical verification of premises is mandatory before grant of registration. Where you have not opted for Aadhaar authentication, physical verification of premises is mandatory before grant of registration. In the other two cases, physical verification of your business premises is optional. Which means if at all you are opted for Aadhaar application where it is successful and it is not risky, physical verification of premises is optional. And even when you're talking about in certain cases that Aadhaar authentication is exempt, physical verification of premises is not mandatory, it is optional. Now this is the amendment in Rule 8 Sub Rule 4A. Now what is the amendment in Rule 9.1 and 9.2? What are they trying to tell? They are telling that if at all physical verification of premises is there, wherever there is physical verification of premises, in which all cases you will have physical verification of premises? In which all cases you will have physical verification of premises? Now, the first case where you will have physical verification of premises is Aadhaar authentication is opted and it is a risky category. Second case, Aadhaar authentication is opted but it is failed. The next case is you have not opted for Aadhaar authentication. You have not opted for Aadhaar authentication, or with the prior permission of any officer authorized by commissioner not below the rank of assistant commissioner, you are going for optional physical verification. You can understand this way. In the first three cases, there is mandatory physical verification. The last case, there is optional physical verification. In all these three cases plus one case, officer will get a time limit. Officer will get a time limit of 30 days, either to grant the registration or to give show cause notice. But when there is no physical verification of premises, in that case, officer will get 7 working days either for grant of registration or for show cause notice. So if there is no physical verification of premises, officers will get 7 working days either to grant the registration or to give show cause notice. When there is physical verification of premises, obviously officer will require more time, that is 30 days, either to grant the registration certificate or to give the show cause notice, either or. And if show cause notice is given, second innings will start. If at all show cause notice is given, then again assessee will reply to the show cause notice within 7 working days, and officer finally has to either accept, that is grant the registration, or reject it. So that second innings will start if at all show cause notice is given. Now, what is the amendment that has been brought here? Earlier, you had only 3 categories where Aadhaar application is opted but it is failed, or not opted, or optional physical verification. Now, even if Aadhaar authentication is opted and it is successful, but it is a risky category, even then you have mandatory physical verification. So the amendment which is brought here is adding this category, where for this category officer will always have 30 days time, because there is mandatory physical verification, either to grant the registration or to give show cause. So that is the amendment which has been brought down in your rule 8.4a application for registration, read along with rule 9.1 and 9.2 of your CGST rules. And moving on to the last amendment of your registration chapter, there is an amendment which has been brought in your rule 12 of CGST rules, basically where we are talking about registration of GST TDS number or GST TCS number. Now understand that previously when you are talking about GST TDS number, basically taken by government or government undertakings, and GST TCS number taken by electronic commerce operator. Normally there the option of cancellation was not there. Cancellation earlier can be done or initiated only by the proper officer. Now the provision has been rectified. It is a kind of rectification amendment, and cancellation of GST TDS number or TCS number can be made by the assessee himself. Not necessarily it is done only by the proper officer. Now this cancellation can start even by assessee. So cancellation proceedings can start by the assessee also. Earlier it was allowed, or cancellation of TDS or TCS number was possible only if the department is starting it. Now cancellation of GST TDS number, TCS number can be initiated by assessee himself. So that is the amendment which is brought in your rule 12.3 of your CGST rules. And all these amendments that you discussed, the effective date of that, be it rule 12 or rule 9192 or your rule 8, basically. If you see your rule 8, basically all these amendments are effective from your 26th of December 2022. Whereas when you talk about your biometric based Aadhaar authentication, it is that amendment is brought on 31st of March 2023, but it is effective again from the same date, 26th of December. So all the amendments in your registration chapter are effective from your 26th of December 2022. So one of the amendment came on 31st of March, even that is retrospectively effective from 26th of December. Yes, friends, now let us move on to your amendments in your input tax credit. Friends, when you talk about your amendment in input tax credit, they are very limited amendments this time for your November 23 exams. First of the amendment is in your rule 37 of your CGST rules, where it talks about condition for taking the credit. Friends, you need to understand that the criteria for taking the credit are given in section 16 of CGST Act, read along with rule 36 and rule 37 of CGST rule. Basically, the main rule is rule 36. Rule 37 talks only about one criteria: if the recipient is not making the payment of consideration within 180 days, then he has to reverse the ITC. But there was an issue when there was an amendment last time. What was the amendment last time? To understand the amendment this time, the amendment said, supposing you're talking about a supplier and you're talking about a recipient. So what was the basic amendment last time? It was said that if at all you're talking about a supplier giving, say, the goods of the value of 10 lakhs plus GST at 18%, 1,80,000, supplier needs to pay output tax of 1,80,000, and recipient will claim input tax credit of 1,80,000. Now the problem with the amendment which came last time is if at all the recipient is not making the payment, if recipient is not making the payment, non-payment of both this price plus GST within 180 days, then there needs to be reversal of ITC. The problem with reversal of ITC was, assume a scenario where recipient has almost paid entire amount. So the payment which is made is out of say 11,80,000, 8 lakh amount is paid, and non-payment is not 11,80,000. It is only and only your 3,80,000. The problem with the provision was, when it was amended last time, the reversal of ITC will be of entire amount. Entire amount. What was the ITC taken? ITC taken was your input tax credit taken was 1,80,000. Now reversal of ITC as 3,80,000 is not paid within 180 days would be entire 1,80,000. So if you could understand the scenario, recipient has already made the payment of 8 lakh. What he has not paid is only 3,80,000, which is a part payment which is pending. So reversal now is said that no, you have to reverse the entire ITC. You claimed ITC of 1,80,000. As you have not made the payment of a small amount, you have to reverse the entire ITC. Now this was obviously not logical, because right from the beginning reversal was only on pro rata basis. Now the amendment is, reversal will not be of entire 1,80,000. Reversal will be only of pro rata amount. Only and only of pro rata amount. Out of 11,80,000, 3,80,000 has been, 8 lakh has been paid, and only 3,80,000 is not paid. So now after the amendment, reversal of ITC will not be 1,80,000, it will be proportionately. So 1,80,000 is total ITC for the total amount 11,80,000, but what is not paid is 3,80,000. So pro rata basis, you have to use your calculator and find this number. Obviously it will be a small number. It will not be entire 1,80,000. It is on proportionate basis. So if you see the amendment is telling that if at all part payment is not made within 180 days, only proportionate ITC has to be reversed and not entire ITC. And if you see this amendment has come on your 26th of December 2022, but it is retrospectively effective from 1st October 2022, first time when the amendment was made, which means first time amendment in this provision was made that you have to reverse full ITC on 1st October. Now, right from the beginning of GSC, if the part payment is not paid, only proportionate ITC needs to be reversed to that extent. But on 1st of October, when the rule was amended, it said that you have to reverse the entire ITC. Now they want to nullify that effect. Therefore, if you see this amendment, it has come out on 26th of December 2022, but it is retrospectively effect from 1st of October 2022. What is 1st of October 2022? That was the date when this illogical provision of reversing full ITC was there, even if part payment is made. So that is the reason why it is retrospectively effective. So that is the amendment in your Rule 37. If at all you have partly paid the amount, your part payment, to the extent of part payment, ITC will not be reversed. Only to the extent of non-payment, your proportionate ITC will be reversed. And it is retrospectively effective, which means that right from the beginning of GST, 1st of July 2017 till date, it is always proportionate reversal of ITC. It's always that. Now, talking about the next amendment, which is in form of a new rule. So, one of the conditions which is added, previously when you're talking about your ITC, the conditions for taking the credit were given in section 16, read along with rule 36 and rule 37. Now they have brought out a new rule which is Rule 37A. And the birth of this Rule 37A seems to be, there's a provision called as Section 41. So now when you're taking the credit, still taking the credit is based on Section 16 along with Rule 36 and Rule 37. But because of Section 41, it has given a birth to a new rule called as Rule 37A, which is bringing a new condition. Rather, it is diluting other condition and bringing a new provision. So what it is trying to tell? It is talking about a scenario, if at all supplier has not paid the tax, recipient has to reverse the credit. That's the basic logic. So this point was right from the beginning, that if supplier did not pay the tax, recipient has to reverse the ITC. Very simple understanding. Supplier, you pay the tax and recipient will get the input tax credit. To that extent, that was very clear-cut understanding. Now, what is the amendment that is brought in? How to find out whether supplier has paid the tax or not? This gives birth to your Rule 37A. It tells that where input tax credit has been availed by the recipient in his GSTR 3B for a tax period in respect of that debit note or invoice which has been furnished by the supplier in his GSTR1, which means obviously that's a criteria which was already there. Supplier has to file GSTR1 and the recipient will get the credit in GSTR2B, based on which he can take the credit in GSTR3B. So there's no change to that extent. Either the supplier will file his outward supplies in GSTR1 or invoice furnishing facility, and based on that recipient will take the credit. But what is the new provision telling? That recipient, you have availed the credit based on supplier filing GSTR1 or invoice furnishing facility. But that supplier has not filed GSTR3B. Has not filed GSTR3B. Till which date? Till 30th of September of the end of the financial year in which ITC is claimed, which means till 30th of September of next financial year. Then whatever ITC recipient has taken, it has to be reversed. Right? It goes on. Right? It has to be reversed in that return on or before 30th of November. Though supplier should have filed this GSTR 3B and paid that amount on or before 30th of September of next financial year. But if at all you're talking about a scenario where supplier has not done that, then recipient has to reverse the ITC in his GSTR 3B of the subsequent month. It means that we are talking about October month, which is to be filed on or before 30th of November of the next financial year. And it also tells that if at all, in spite of this provision where supplier has not filed his GSTR 3B supplier has not included that outward supplies in his GSTR 3B till your 30th of September of next financial year, and recipient has not reversed that ITC till 30th day of November of next financial year, then recipient has to reverse that ITC along with interest calculated as per section 50 subsection 3, which means if at all you're not doing a reversal before 30th of November of next financial year, please reverse that ITC with interest. Now it further goes on to tell that in a scenario where supplier subsequently furnishes this GSTR 3B and pays the tax, recipient can re-avail the credit in GSTR 3B of the tax period thereafter. What are they trying to tell? Let us understand this with a scenario. See, the basic criteria is supplier, you have to file your GSTR1 so that the recipient gets it in GSTR2B. So please first make it very clear, if at all a supplier has filed his outward supplies in GSTR1 or invoice furnishing facility, only then recipient will get in his GSTR2B. We are not going to see GSTR2A, which is dynamic. We are going to see GSTR2B, which is static. And only then credit can be taken. So this is very clear. Only and only after supplier furnishes outward supplies in GSTR1 or IFF and it is reflected in GSTR2B, credit can be taken. So credit can be availed only then. This is the first criteria. First criteria. Now they're telling that no, not only this. Not only this. Supplier should also have paid the tax and included the transaction in GST attribute. Please understand that payment is only made when that sale is shown in GST attribute. A supplier might have shown that sales in GSTR 1 or IFF, but might not have included that outward supplies or sales in GSTR 3B. Understand that there is no payment along with GSTR 1 or invoice furnishing facility. Payment is only there in GSTR 3B. So the next criteria tells that supplier should have paid the tax, included that outward supply or sale transaction in GSTR 3B. Understand that there is a difference between the first criteria and the second criteria. The first criteria, only and only when supplier files his GSTR 1 or IFF, only then recipient will get that in GSTR 2B, and only then recipient will claim that credit in his GSTR 3B. Claim that credit in his GSTR 3B. So availment of ITC will be done only that. Supplier has to file his GSTR 1 or IFF. Recipient will get that in his GSTR 2B, which is auto populated. Only then recipient can claim ITC while filing GSTR 3B. That's the only criteria. If that is not done, this will not happen. But when you're talking about the second criteria, supplier may not have included that outward supply or sale transaction in GSTR 3B of that month. Payment might have happened late. And if supplier includes that in any of his return on or before 30th of September of next financial year. 30th of September of next financial year, no need to worry. So if supplier is including that, outward supplies on or before 30th of September of next financial year, there is absolutely no worry. Absolutely, if it is done, there is nothing to worry. If it is not done, then recipient has to reverse the ITC. On or before, in a return on or before 30th of November of next financial year, which means reversal of ITC either it should be in September return or October return. Reversal of ITC should be there in his return, which means in his 3B return, which has to be filed. So it is not November 3B return. That reversal of ITC will be there in recipient's GSTR 3B return, which is filed before 30th of November of next financial year. Let us understand this again. Supplier should include that sale transaction on or before 30th of September of next financial year. If it is done, nothing will happen. If it is not done, then recipient will reverse that ITC in GSTR 3B of subsequent month, which is filed on or before 30th of November of next financial year. Basically, recipient is going to reverse ITC either in September month return or October month return to be filed on or before 30th of November. If not done before that, then it will be along with interest at 18%, and that interest will be from 1st December of next financial year. So interest will be from that. Basically, if you understand this criteria, one will surely have a doubt. And this is basically the provision. The provision goes on to tell us that in case reversal happens and supplier pays the tax thereafter. Finally, supplier pays the tax late thereafter. And if at all you have already reversed the credit, you can reclaim the credit. Reavail the ITC. But not the interest portion. Interest paid will be cost. So finally, if supplier is finally paying that tax on outward supplies, but not before 30th of September, which means it is done later. Then you can re-avail that ITC, whatever you have reversed, but not interest portion. Please understand the issues here. First of all, understand that there was no need of having this point called as 30th September. There was absolutely no need. It could have been very well said that if supplier is not paying the tax in any of his return on or before, filed on or before 30th November, then recipient has to reverse it with interest. That's it. Interest will start from 1st December. Why I am telling that there was no need of 30th September is, assume a scenario where supplier is paying the tax after 30th September. Assume a scenario, which means, say, supposing supplier is paying tax in October return of next financial year. Right? Provision tells that you have to reverse the ITC and you have to reclaim ITC. So there's no need of reversal, there's no need of reclaiming, because recipient has to reverse the ITC on or before 30th of November of next financial year. So supplier has paid the tax in October return of next financial year. So strictly speaking, the provision tells that recipient has to reverse, but recipient has to reverse when? On or before 30th of November. And the recipient will not reverse it because though supplier has paid the tax after September 30th, it has been included in October return of next financial year, and recipient was having time for reversal till 30th November of next financial year. So recipient will not at all reverse the ITC. There's no question of any interest, no question of reavailment. So this 30th September is basically unwarranted. Basically, you understand, you can understand this in a very simple way, that if supplier is paying the tax and reflecting in any of the return filed before 30th of November of next financial year, recipient need not reverse the credit, and if it is not done, then recipient needs to reverse the ITC in his 3B return, basically not November return, any return on or before October return, and reverse with interest. Maybe this time gap between 30th September and 30th November between supplier and recipient is only to ensure that recipient is ready. That could be the intention of the lawmakers. Otherwise, 30th September of next financial year really doesn't make sense. So the intention of the lawmakers is, see, your supplier has not yet filed on or before 30th of September of next financial year. Inform the supplier and ask him to pay the tax. If he has paid it in October return, well and good. Then there is no need of reversal of ITC, no need of interest, no need of reclaiming. If he has not done before 30th of November of next financial year, then you reverse in your GSTR 3B, not November 3B. It is up to last month is October GSTR 3B, because that has to be filed on or before 30th November. November 3B will be filed after 30th November. So any return to be filed before 30th of November of next financial year, which is basically October month return is the last return of the next financial year, in which you have to reverse that ITC. And if you reverse that on or before 30th of November of next financial year, no interest. If you reverse thereafter, interest will start from 1st of December of next financial year. And as and when supplier is paying that tax and including in his GSTR 3B, recipient can re-avail the ITC. Now, the first issue that I pointed out, issue number 1, this 30th number is unwanted. Issue number 2, supplier may not pay that in his GSTR 3B. He may pay by voluntary payment DRC 03 challan. So here they should have said that supplier is paying the output tax on such outward supplies either in his GSTR 3B or by DRC 03. Either or. So here issue number 2 is, they are telling that for reclaiming the ITC, supplier should have included in his GSTR 3B after 30th of November, and where recipient can revalue the ITC but not the interest. So it is possible that supplier is not paying that tax or including that tax in GSTR 3B, but he is including that in DRC 03 challan. So they should have addressed this voluntary payment by DRC 03 challan, which is not addressed. That is issue number 2. Issue number 3. See, basically understand that GSTR 3B is a proof of filing. In GSTR 3B, there may be non-payment of tax or short payment of tax. As a recipient, you might see whether the supplier has filed his GSTR 3B or not. You can ask the supplier and he can give the proof. Or through private software, you can check whether the supplier has filed GSTR 3B or not. but you cannot check whether your outward supplies is included or not. So issue number 3 is given in form of author's note, where it is addressed that your section 37A is coming out of your section 41. Section 37A is only concerned with GSTR 3B of the supplier, ignoring short payment of taxes by the supplier. Which means that supplier might have filed his GSTR 3B, but it is still possible that supplier has not paid the full tax. Now, government is assuming that if supplier is filing GSTR 3B of that month, including that sales, it is assuming that supplier has paid the tax. But it is highly impossible for the recipient to verify about the payment of tax by the supplier. All he can do is he can check whether the supplier has filed GSTR 3B for that month or not. So, if GSTR 3B is not filed by the supplier, recipient has to reverse ITC. But GSTR 3B can be filed by the supplier with short payment of taxes or not including that taxes. Now in that case, recipient is not required to do anything. So this assumption of the government that when supplier files his GSTR 3B, it means that he has included the outward supplies of the sales and paid the tax. This assumption will go for a toss, and recipient will not be under any position to check that whether supplier has included his transaction in his GSTR 3B. Recipient can check whether supplier has included his transaction in GSTR 1 or IFF, but not check whether the supplier has included his transaction in GSTR 3B. So this criteria is in fact diluting the condition of payment of tax by the supplier. Yes, payment of tax by the supplier can be checked by the officer later again. But as of now, you're asking the recipient to reverse the ITC based on supplier not filing his GSTR 3B or not including his sales in GSTR 3B of that month, which basically makes this provision coming out with certain issues, the issues that we have discussed. Now let us understand this, both the criteria that we have discussed with the help of an example. Let us see example 1. Supplier has supplied you on 25th of April, included in GSTR 1 of April month, which is filed on 10th May. So recipient will get that credit, recipient will get that ITC in GSTR 2B of April itself. Therefore, recipient will avail the ITC in April 2023 GSTR 3B return itself. Supplier has paid the tax while filing his GSTR 3B. That sale transaction is not included in April month return, but it is included in July return of next financial year. The sale happened on April 2023, included in GSTR 1 of April 23. Sale happened on April 23, 25th April, included in GSTR 1 of April 23, and that April 23 GSTR 1 was filed on 10th of May, which came in GSTR 2B of April 23 for the recipient, and recipient took that credit. Recipient took that credit in April 23 GSTR 3B return. Supplier included that sale transaction and paid the tax while filing GSTR 3B of July 24, which means July 24 is next financial year. Now, whether the condition number 1 as discussed is supplier should have included in GSTR 1 or IFF, recipient will take the credit, that is satisfied. Condition number 2 is supplier should have included that sale transaction, but that need not be checked real time, that can be checked later on. If at all I want to avail the ITC, all I need to check is whether supplier has included that transaction in GSTR 1 IFF, whether I have got in my GSTR 2B. If yes, I'll take the credit. Supplier, whether he has included the transaction in 3B, I need not check real time. I have time. Supplier can include the transaction in GSTR 3B of any month filed before 30th of September of next financial year. In this case, yes, it is filed before 30th of September of next financial year. Nothing will happen. Recipient has already taken the credit. There is no question of reversal of ITC. Right. Now let us see the next scenario. Now what has happened is, again we have taken the same example. Supplier has made a supply on 25th of April 2023, included in GSTR1 of April 23 month itself, but filed on 15th May. So the sale transaction happened on 25th of April 2023 for the supplier. Supplier has included that in GSTR1 of April 23 itself, but that is filed late. So this will be reflected in GSTR2B of the recipient, not of April 23 month, but of May 23 month. So recipient will take that credit while filing his GSTR 3B return. That availment of credit will happen only in May 2023. So that's the difference in example 1. In example 1, supplier made the supply on 25th April, included in GSTR 1 of April 23, but filed on time, filed on or before 13th. On or before, if at all you're talking about GSTR 1, it was all filed before it was reflected in GSTR 2B. So it was filed before that time. Now in this case, it is filed after the time, that is the 13th May is the deadline. It's filed after that time. Therefore, though supplier has included that in April GSTR1, recipient will get that in 2B of May. Supplier has included in April 23 GSTR1, but recipient will get that item reflected in GSTR2B of May month, and recipient will take the credit only in May return, not in April return, not in April return. So first condition is supplier, you file your GSTR1 IFF. If at all filed on or before the due date, then it would have been taken in that month itself. If at all April month return was filed before the due date, then recipient would have taken the credit in April 23 itself. But supplier has filed GSTR1 of April after the due date on 15th May. So recipient will get that transaction only in GSTR2B of May 23, not of April 23, and recipient will claim that ITC only in May 23 return, not April 23 return. So that is a change. Supplier has paid the tax. Now that sale transaction or output supply transaction was not included in GSTR 3B of April. It was included in GSTR 3B of September 2024. It was not included in GSTR 3B of April 23. It is included in GSTR 3B of September 24, which means you're talking about September of next financial year. And that September month return was filed on or before October. Understand that supplier has included that transaction after September of next financial year, but recipient has got that before 30th November of next financial year. In that case, there is no need of reversal. There is no need of any reversal. Though supplier has included in GSTR 3B filed after September of next financial year, but recipient had time, extra time. Recipient had cooling period of 2 months. Recipient got that before 30th November of next financial year, because supplier included that, though it is after 30th of September, supplier included that in September return, filed on 25th of October 2024. So it was between this time. Supplier did after 30th September, but recipient got before 30th November. So there is no need of reversal of ITC. There is no need of reversal of ITC. As discussed earlier, the 30th September is not so important. Remember, finally, it should have been included in supplier's GSTR 3B filed on or before 30th November. The recipient need not reverse the ITC. If at all it was not reflecting before 30th November of next financial year, then recipient should have reversed the ITC. And finally, let us see your example 3. Supplier has made a supply, output supply on 25th April 2023. Included in GSTR 1 of April 2023, filed on 15th May. Filed on 15th May. As it is not filed on or before due date, that is for April month, we are assuming that we are talking about finally, it should have been, though the due date is 11th May, it should have been done before 13th of May, because 13th of May your GSTR 2B will be ready. So as it is not done before that due date, it will not come in GSTR 2B of your April month. It will come in GSTR 2B of May 2023. It is not going to be reflected in GSTR 2B of April 23. So recipient will avail that ITC, yes, but only in May 2023 return and not in April 2023 return. So this is basically the same as the previous example. Supplier has included that sale transaction or outward supply transaction in GSTR 3B of December 24, which means you're talking about GSTR 3B of a return in next financial year, which is December 24 return is filed on January 25th, 2025. Now, what will happen is recipient now has to reverse the ITC. Recipient now has to reverse the ITC in any of the return, whether it is September return or October return filed before 30th of November 2024. So recipient has to reverse the ITC this time because the payment has been made by the supplier by including the transaction GSTR 3B of December of next financial year. So reversal should be done in any of these returns, whether September return or October return filed before 30th, whether in September return or in October return, that is September 3B or October 3B, but filed before on or before 30th of November 2024. If not, interest will be there at 18% per annum from your 1st December 2024. If you reverse before that time, no need of interest, otherwise interest. And second stage, as supplier finally pays the tax on the transaction by including the transaction in December 2024 return filed on 25th. So there will be re-availment of that ITC, while filing Jan 2025 return. So why there will be re-availment of ITC? Because supplier has finally paid the tax by including in December of return of next financial year, and recipient will come to know only in January month. So recipient can claim the credit only in January 2025 return, which when he is filing his Jan 25 GSTR 3B return, he will reclaim the credit. If at all there was late reversal and that was with interest, the reclaim will be only of ITC, not that of interest. So that is all about the amendments in your ITC chapter. Yes, friends, now let us see the amendments in your document and your e-waybill chapter. Small amendments are there. The first of the amendment that you could find is in your Rule 46 of your CGST rules. Basically, there is a Rule 46 sub-rule F which tells that the recipient's name and address is not required if at all you're talking about the value being less than 50,000. But there's a proviso now attached to this sub-rule which tells that if at all you're talking about any taxable service, first of all, they are not talking about goods. They are also not talking about exempt service. So it is neither for goods nor for exempt service. This proviso is only for a taxable service, and that too it is supplied either by electronic commerce operator or through electronic commerce operator. So the supply is by ECO or through ECO or by a supplier of OIDAR service, right, to a recipient who happens to be unregistered recipient, irrespective of the value. Even if the value happens to be less than 50,000, even then it shall contain the name and address of the recipient. Not only that, it shall be there along with the PIN code and the name of the state. This is only to ensure that it is very easy to identify the place of supply in such case of supply of taxable services through ECO or by OIDRS to unregistered recipient, and so that the revenue goes to the correct destination state. What are they trying to tell you? Basically, Rule 46F tells that if at all the value happens to be less than 50,000, name and address of the recipient is not required. There is an exception to it. What is that exception talking about? If the supplier is ECO or supplier is through eco or supplies of online information database and access and retrieval services, online information and database access and retrieval services. In that case, and if the recipient is unregistered recipient, and if the recipient happens to be unregistered recipient, then whether the value is less than 50,000 or more than or equal to 50,000 does not makes any difference. There should be name and address of the recipient with entire pin code, state and the pin code, so that the revenue goes to, this is only and only to ensure that it is very easy to identify place of supply and the revenue reaches the destination state. Is this applicable for everything? No, it is not applicable for your goods. It is not applicable for your exempt service. It is only applicable for your taxable service. So supply is of taxable service, supplier is eco, or supplier is supplying through eco, or supplier is providing OIDRS services to the unregistered recipient. So there are three criteria. Criteria number 1, supply is of taxable service. 2, who is the supplier, eco or through eco or OIDRS. 3, recipient is unregistered recipient. And in such cases, whatever is the value, there should be name and address of the recipient along with the state and pin code, so that it is very easy to find out place of supply and the revenue finally goes to the destination state. So that is the amendment in your rule 46. Now, the next amendment, that's all about this amendment which was that in rule 46. The next amendment is in rule 46A. That is more of clarificatory in nature. So when you talk about a combo document, which is invoice cum bill of supply, which is only when the supplies of taxable goods, services and exempt goods and services together to an unregistered recipient. So supplies of both taxable and exempt goods and services, and both are given to together to an unregistered person. The document which will be there is invoice cum bill of supply. In that case, this combo document, single invoice cum bill of supply, shall contain the details of invoice given in rule 46 as well as your bill of supply given in rule, invoice, content of invoice given in rule 46, special cases rule 54, as well as it shall contain the details of bill of supply given in rule 49. So it is telling that as it is a combo document, invoice cum bill of supply, it shall have the details of tax invoice as per rule 46 read along with rule 54. It shall also have the details of the contents of bill of supply. This amendment is more of clarificatory nature. It was right from the beginning the same. And both these amendments in rule 46 as well as your rule 46A are effective from your 26th of December 2022. Now the amendment which has come in your e-waybill provision, that is rule 138. So when you talk about annexure to rule 138 sub rule 14, it tells that for the following items, for the following cases, e-waybill is not required. And one of the item that you see in annexure to rule 138 sub rule 14 is when you're talking about jewelry, goldsmiths and silversmiths, wax and other articles under chapter 71. So jewelry items, there is no requirement of e-waybill. Now they are talking about an exception. Imitation jewelry, which is again covered in your chapter 71, heading 71(1)(7). For imitation jewelry, now they are telling that no, e-waybill is required. So basically for jewelry, e-waybill is not required, but for imitation jewelry, now that exemption is removed and e-waybill will be required. So because the exemption is removed, therefore e-waybill will be required. So this is also effective from your 26th of December 2022. So that is an amendment in your e-waybill. Now there is a circular which is talking something about your e-invoice. So what is that circular? The circular is basically telling that when you're talking about exemption from e-invoice, whether the exemption which is from e-invoice is for the entity as a whole or in respect only of certain supplies. If you see the exemption, in the exemption list you will find even banking sector. So the circular is taking the example of banking sector and it is explaining whether banking sector is involved in supplying banking services or involved in making supply of some goods. Say for example, say there is a sale of capital goods. The exemption from e-invoice. Exemption from e-invoice is not only for banking services but also for other supplies, say for example supply of capital goods for banking. So it is clearly telling that this exemption is for entity as a whole and not restricted to particular transaction. So if at all you're talking about that exemption, one of the exemption which is there from invoicing is for banking sector, that is banks, financial institutions and non-banking financial companies. So whether it is banking services, there's no requirement of invoice, or whether is there some other supply, say for example supply of capital goods, even for that there's no requirement of e-invoicing. So this is the clarification, clarifying the scope of exemption from e-invoice. Yes friends, now let us discuss about your amendment in payment chapter and your return filing chapter. So let us first start with your payment chapter. There is an amendment in your electronic cash ledger, rule 87. So that amendment basically is talking about a scenario where you have made the payment. You have made the payment, but you have not got the details of challan identification number on the common portal. So the payment is made, debited from your bank account, but the details are not reflected, which means you don't get your challan identification number on the common portal. Then your cash ledger may still be updated, though you don't get a challan identification number, but still your cash ledger may still be updated on the basis of e-scroll of RBI in case the details of e-scroll of RBI are matching with the details in challan generated in PMT 06, which basically means that they are giving an additional step. If at all, whenever you make the payment and it is debited from the bank account, but SIN is not generated. Now, even though SIN is not generated, your electronic cash ledger may still be updated on the basis of e-scroll of RBI if at all the details are matching with the challan. And in case, assume this is only an additional step. If it is not matching, then obviously the last resort for a person is to make a representation electronically on common portal to the bank or the electronic gateway through which the payment is deposited and tell that, see, I've made the payment. You have to put a grievance on the common portal telling that I've made the payment, but still it is not reflected on the portal, though the amount is debited from the bank or the electronic gateway through which the payment was initiated. So they have added an additional step. You have made the payment, but still you have not got the challan identification number. Don't worry. If at all the details of your challan are matching with e-scroll of RBI, again your cash ledger will be updated. But if that is also not matching, then the last resort was already available to you. You have to go on the common portal and put your grievance and intimate the bank or the gateway telling that my payment is not yet reflected on the portal. So that is the amendment in your rule 87, electronic cash ledger. Now the next amendment is the introduction of a new rule, which is rule 88C, a very new rule, rule 88C, where it tells that the details of outward supplies reflected in GSTR1. So your outward supplies that you are reporting in GSTR1 is more than that of GSTR3B. So your outward supplies that you have reported in GSTR1 is more than that of your GSTR3B, which may lead even to cancellation if you see your cancellation provision. But now we are not discussing about that. Basically, what this rule 88C is trying to tell. This rule 88C is trying to tell that if at all a person has filed his statement of outward supply, that is sales, either in GSTR1 or invoice furnishing facility for a tax period, and that is more, that is sales and output tax is more in GSTR1 or IFF compared to your GSTR 3B. Now, when you're talking about more, they tell a very clear cut point that it should be more by such amount and such percentage. So they talk about amount and percentage which is yet to be notified. It should be more than GSTR 1 outward supplies and tax on it should be more than GSTR 3B, such amount and such percentage as may be notified by GST Council, which is yet to be notified. Then in that scenario, that person will get an intimation on the portal in form of GSTR DRC 1B. GST DRC, GST, not GSTR, GST DRC 01B. It will get that intimation in part A of GST DRC 01B. Right, where it will get on the common portal. Also, that intimation will be mailed to the mail ID. So automatically it will be put on the common portal and it will also be sent to the mail ID, highlighting that differences. So if at all your outward supplies and the tax payable on it is more in GSTR 1 or IFF compared to GSTR 3B by such amount and such percentage, then you will get an intimation in part A of DRC 1B, 01B. That will be there on the portal as well as the mail ID. What it will tell, highlight the differences. And then this particular person, assessee, will have two options. Either to pay that differential amount with interest or explain the reason for the difference. Either pay with interest or explain the reason for that difference. There can be reasons why this difference is there, and that needs to be done within 7 days. So when you're talking about either making the payment or explaining that, if you're at all you're making the payment, it should be paid by your voluntary challan GST DRC 03. If at all you're explaining the difference, it will be explained in part B of DRC 1B. So when you are making the payment, that payment should be closed by GST DRC 03. If at all you are not making the payment and you are explaining the differences, it is by part B of GST DRC 01B. And in case they give the last resort to the department, in case that amount remains unpaid plus explanation is not given or explanation given is not satisfactory, amount is unpaid plus no explanation, or amount is unpaid plus explanation given but not found satisfactory, then that amount is directly recoverable without any show cause notice and order, directly recoverable in terms of section 79. So when you talk about direct recovery, there is no need of show cause notice, there is no need of demand order, there will be direct recovery. Right, so the basic steps are, if at all there is any difference between your outward supplies between GSTR 1 and 3B by such amount or such percentage, the officer will give you DRC 01B. It will be there on portal and it will come to a mail ID. Either you have one option to pay that with interest, DRC 03, or to reply the reason for differences. It is part B of DRC 01B. Reply the differences. And finally, if you have not paid that amount and not replied, or not paid that amount, replied but not satisfactory, then that will be directly recoverable. When I tell direct recovery is there won't be any show cause notice demand order. There will be direct recovery in terms of section 79. So that is the new rule talking about rule 88C. And all these amendments are effective from 26th of December 2022. The corresponding effect of this new rule, which is coming on 26th of December 2022, is an amendment in your return filing chapter. So if you see your return filing chapter, the first amendment in return filing chapter is in rule 59, which is for your GSTR 1 and IFF. So there is a corresponding effect. There is a corresponding effect in your GSTR 1 IFF. Now, what is that effect? If at all you're receiving that intimation, if at all for a tax period, you are getting that intimation as per your Rule 88C. This is a corresponding effect because of Rule 88C. If you are getting an intimation as per Rule 88C, you cannot file GSTR1 IFF of the subsequent month. Say for example, you are getting that intimation based on Rule 88C in June month. You cannot file IFF or GSTR1 of July 2022. But understand that this restriction is valid only till the time the payment is made or reply is given. Which means you are getting that intimation in June as per Rule 88C. Your GSTR1 or IFF cannot be filed from July 22. But if you have given the reply, or if the payment is made, if the payment is not made, reply is not filed, from July 22 onwards, your GSTR1 IFF will be blocked. But if you have made the payment or filed the reply, then again you can still go ahead and file your GSTR1 or IFF of July 22. So basically it is telling that for those who have got intimation as per Rule 88C, they will not be allowed to file their GSTR1 IFF from the subsequent tax period. So that is the basic point. But there is an exception. Exception is if at all you have paid that amount or if you have replied, then you can still file IFF or GSTR1 of the subsequent month. So that is a corresponding amendment in your return filing chapter in your Rule 59. Now the next amendment in your return filing chapter is rationalization of late fees for annual return. So when you talk about your section 47, it talks about the late fees. And when you talk about the late fees for annual return, under section 44, annual return which are filed under section 44, the basic late fees for your annual return was, basic late fees, it was rupees 100 per day subject to 0.25% of state or union territory turnover, whichever is lower. This is CGST late fees, copy paste SGST late fees. So prima facie, when you see your section 47, you will find the late fees as rupees 100 per day or 0.25% of state turnover, or turnover of the state or union territory, whichever is lower. This is CGST late fees, copy paste for SGST late fees. Now they have rationalized it. What's rationalization they have brought out? They have categorized it. If at all your aggregate turnover up to 5 crores is up to 5 crores in that financial year, not the previous financial year, the financial year for which you are filing your annual return, then the late fees is rupees 25 per day, not 100 per day, subject to a maximum of 0.02% of the state turnover. So 100 per day suddenly becomes rupees 25 per day. 0.25% of state turnover becomes 0.02% of the state turnover. Copy paste is for SGST late fees. Assume you're talking about your annual return where your turnover is 1 crore and there is a delay of 75 days. So it will be rupees 25 per day for 75 days or 0.02% of state turnover, whichever is lower. In this case, if you calculate, the lower portion will be 1,875. If I tell that for the same case, you're filing annual return where your state turnover is 1 crore and now the delay is not for 75 days, it is for 100 days. So it is rupees 25 for 100 days or 0.02% of state turnover, 1 crore, whichever is lower. In this case, the lower amount will not be 1875, it will be 2000 rupees. It will be 2000 rupees. So here it was basically 1875 or 2000, whichever is lower. Here it is basically 2500 or 2000, whichever is lower. And basically understand that this is CGST late fees, copy paste for SGST late fees. This is the first part. The second part, if at all your aggregate turnover, now you're not talking about the conceptual part, is based on aggregate turnover. If at all your aggregate turnover, not state turnover, if at all your aggregate pan-India turnover exceeds 5 crores, but it is up to 25 crores in that financial year. Please understand that for checking in which category you're falling, you're seeing pan-India turnover and you're seeing turnover for the current financial year, not previous financial year. You're seeing pan-India turnover and not state turnover. Because conceptual point. So if you're checking whether you're big or small, you see pan-India turnover and you see that financial year because you're going to file annual return in the next financial year. So you're not seeing for the previous financial year. Now it is from 5 crores to 25 crores. In that case, your late fees is 50 per day. CGST late fees 50 per day, subject to maximum of 0.02% of state turnover in state or union territory. So the second slab, that percentage is the same, 0.02% of state turnover, but now it becomes rupees 50 per day. Now let us understand. If I tell your turnover is 10 crores, your aggregate turnover, not state turnover, your aggregate turnover is 10 crores, and there is 75 days delay. So it is rupees 50 per day for 75 days or 0.02% of 10 crores. 0.02% of 10 crores, whichever is lower, which will give you 3750. It is CGST late fees, copy paste for SGST late fees. If I were to tell that no, your turnover is 10 crores, aggregate turnover, not state turnover, though it is in the example it is talking about state, but conceptually you are going to see aggregate turnover, which category you're falling, 5 crores to 25 crores, 10 crores, and the delay is of 100 days. So it is rupees 50 per day for 100 days or 0.02% of state turnover, which is lower. So here you will find rupees 50 per day for 100 days is 5,000 and 0.02% of 10 crores is also 5,000, which is lower is you will get the same amount, 5,000. This is CGST late fees, copy paste for SGST. Whereas in the previous case, rupees 50 per day for 75 days is 3750 or 0.02% of 10 crores 5,000, which was lower was 3750. We have paid CGST rate fees, copy paste for SGST. And finally, if your aggregate turnover, it's not state turnover, pan-India aggregate turnover. If your pan-India aggregate turnover of that financial is more than 25 crores, it's not state turnover, pan-India aggregate turnover of that financial year, then the normal late fees, it is now rupees 100 per day, subject to a maximum of 0.25% of turnover inside the state or union territory. Normal late fees. So if I had to tell that no, your turnover happens to be 50 crores, more than 25 crores, and the delay is of 75 days. So it will be rupees, now it is 100 per day for 75 days or 0.25% of that state turnover, which is lower. So which will be 7,500. This is CGST late fees, copy paste for SGST. For the same situation, if at all your turnover is 50 crores, more than 25 crores, aggregate turnover, and the delay is for 100 days, it is again rupees 100 per day for your 100 days or 0.25% of your state turnover 50 crores, whichever is lower. Again, you will get the late fees of 10,000. So you have to just calculate it. You have to remember the slab. If your aggregate turnover is up to 5 crores, then it is 25 per day or 0.02% of state turnover, whichever is lower. CGST late fees, copy paste for SGST late fees. If your aggregate turnover for that financial year is 5 crores to 25 crores, exceeds 5 crores but up to 25 crores, then it is rupees 50 per day, not 25, rupees 50 per day, subject to maximum of 0.02% of state turnover, whichever is lower. CGST late fees, copy paste for SGST late fees. But if your aggregate turnover, pan-India turnover for that financial year crosses 25 crores, then it's normal late fees, rupees 100 per day, subject to a maximum that is point subject to maximum 0.25 percentage of state turnover, that is rupees 100 per day, or 0.25 percentage of state turnover, whichever is lower. The CGST late fees, copy paste for SGST late fees. So that is rationalization of late fees of annual return. We have already discussed that there is late fees rationalization for GSTR 1, GSTR 3B, GSTR 4, and even your TDS return GSTR 7. So there is already rationalization of late fees of 1, 3B, 4 and 7. Now there is a rationalization of late fees for your GSTR 9, 9A as well. Yes, friends, now let us discuss about a very interesting circular which deals with basically section 12 subsection 8 of IGST Act. So Central Board of Indirect Taxes and Customs came across a very interesting issue, and they have tried to give it their best clarification, but we'll see because of this clarification there are other issues which are coming up. Now let us see the issue on hand. If at all you're talking about section 12, you need to understand that both location of supplier and location of recipient are within India. So you're talking basically about, in this case, transportation of goods including by mail or courier. When you're talking about transportation is to a place outside India, when the transportation is to a place outside India, the place of supply in such a case would be the destination of goods and not the recipient. So if at all you're talking about location of supplier, that is the transporter and the recipient in India, but the transportation is out of India. The transportation is out of India, which means it is export of goods. Someone is exporting goods. Say for example, I am exporting the goods. Right? Who's the supplier? Transporter is the supplier and I am the recipient. Both are in India. The place of supply in such a case is destination of goods. Let us take an example. The circular itself gives an example where X is the registered person in GST in the state of West Bengal who is planning to export the goods to a person Y located in Singapore. So I am X in West Bengal exporting the goods to Y in Singapore. I am taking the services by way of transportation of goods by air from an air cargo operator Z. So I am talking about taking the services from a transporter, in this case the air cargo operator Z, who is also registered in West Bengal. So basically you are talking about your location of supplier. Supplier is your air cargo operator Z, West Bengal. Recipient is your Mr. X, who is also located in the state of West Bengal, and the supply given by the supplier to the recipient is transporting the goods. The supply is that of transportation of goods outside India, because there is export of goods. Now please understand that Y of Singapore is not relevant. You need to focus on Z, the supplier of transportation service West Bengal, X, the recipient of transportation service West Bengal. But the goods are going outside India. When the goods are going outside India, place of supply in this case is destination of goods, and in this case the goods are going to outside India, Singapore. And the tax which will be charged, though both supplier and recipient are in India, the tax that will be charged, transportation charges plus it will be IGST. Why it will be IGST? Because the supplier is located, location of supplier is in West Bengal, and place of supply is outside India, that is Singapore. And the location of supplier, when the location of supplier is West Bengal and place of supply is outside India, then the tax would be IGST. The tax would be IGST. So what is the place of supply? We know what is the place of supply as per section 12 subsection 8 exception, and what is the type of supply? It is interstate supply. The question is, can this IGST ITC, so supplier is going to pay output IGST. Supplier is going to pay output IGST. Can the recipient claim the input tax credit of this IGST? Can the recipient take this input tax credit? The basic question is whether the recipient can take this credit of IGST. Because basically both supplier and recipient are there in the same state. Even though they are in the same state, there is IGST. And this IGST basically is not dealing with West Bengal. This is IGST pertaining to Singapore. So can the recipient take ITC? Now when you analyze that, if you see the basic provision for taking ITC, it is section 16. So section 16 gives the conditions for taking ITC and section 17 gives the list of blocked ITC, including talking about proportionate ITC. If you see both section 16 and section 17, there is no restriction not to take such ITC where the place of supply is outside India. You will not find such restriction. That being the case, the recipient will be in a position to take the ITC of this IGST. So here you need to understand that the basic intention of the circular was to understand what type of tax it will be. Basically, first, what would be the place of supply? Second, what type of tax it would be? Third, whether ITC will be eligible. That was the main question. Yes, the recipient can take the ITC of the IGST charged by the supplier, though this IGST pertains towards Singapore, right? And if you see the supplier, then supplier is filing his GSTR 1, and the supplier will file his GSTR 1, the transporter will file his GSTR 1. In this case, our cargo operator, he'll put that IGST, that code, state code, because the state code will not be of West Bengal. The point that I want to make is state code will not be of West Bengal, state code will be a foreign country. Credit is taken by a recipient in West Bengal. Credit is taken by a recipient, Mr. X in West Bengal, but the state code is not of West Bengal. The state code is of foreign country, 96. So this is very interesting. What are they trying to tell? Recipient can still avail. If the state code was of West Bengal, there's no issue at all. Though it is IGST credit would have been taken. The interesting point is, when the supplier is giving the state code in his GSTR1, he will not write the state code of West Bengal because the place of supply pertains to Singapore, outside India. So that being the case, interstate supply, because it pertains to outside India, Singapore. So we'll write the state code as 96. See, if the state code was West Bengal and it was IGST, there was no issue at all. Now the state code happens to be 96, foreign country outside India, but still the circular tells that you can take credit. Now when I started the circular, I said that it is going to open Pandora box. So this was finally the circular, and it is in favor of associate, telling that though it is both supplier and recipient are in the same state, still there can be IGST, not a problem. But this IGST does not have state code of West Bengal, the recipient state code, it is having the state code of foreign country. But still the circular is telling that recipient, you can still avail the credit. This will open up a lot of issues. Say for example, you are talking about company in the state of Maharashtra, where the director is going to Delhi and staying in a hotel in Delhi. Now what will happen is supplier will be the hotel in Delhi, and recipient will be the company in Maharashtra. If you see the place of supply, in this case, place of supply as per section 12 subsection 3 for immovable properties is location of immovable property. So what will happen is location of supplier is Delhi, and immovable property, place of supply will also be Delhi. Therefore, when the supplier is going to raise invoice against the recipient, it will raise accommodation charges plus CGST, SGST. This SGST will be of Delhi. Why? Because the location of supplier happens to be Delhi, hotel is in Delhi, and the place of supply as per section 12 subsection 3 happens to be location of property Delhi. Now, the tax which will be charged by the hotel is CGST, SGST. CGST and SGST. Can the company of Maharashtra take the input tax credit? What will be the output tax? Output tax will be CGST, SGST. Can it take the credit of CGST, SGST? So based on this circular, the intention of the circular is pointing that it is satisfying all the criteria of section 16 and section 17. There's no blockage in section 17. Going with this analogy, it can take the credit. But if you go as per circular, the circular will tell that yes, prima facie yes, no issues with CGST, SGST, there might be some issues. Because this SGST, mind you, this SGST is of Delhi. The recipient is in Maharashtra, but this SGST basically is of Delhi. So as per going with the circular, the answer is yes, but logically, the answer should be no. So this will have a lot of issues later on. Because of the circular, logically the answer should be no. Why logically the answer should be no? The reason is this CGST, SGST pertains to the state of Delhi and the recipient is located in Maharashtra. Though it is satisfying all the conditions of section 16 and not blocked under section 17, but still based on the dual model of GST that India has, rightly speaking, logically speaking, credit should not be given. But the circular points otherwise. So this circular has opened up the Pandora box. I'm not concluding the answer for this. I'm just telling logically the answer should not be there. The ITC should not be given of this. But if you read the circular is trying to tell that forget about your place of supply and other stuff, you can take the credit. Even if you see the written filing concept, if you go to the instructions of written filing concept, you will find that the lawmakers are telling that ITC cannot be taken. So basically for such cases, you cannot go with the circular. You have to ignore the circular. You have to take the circular only for this special case, very specific case, not apply to other cases. Yes friends, now let us discuss about the amendment in your demand and recovery chapter, which has come in your rule 161. A very basic and small amendment which has got no effect. It is merely clarificatory in nature. Basically, when you talk about 161, what if you're talking about certain proceedings, continuation of certain recovery proceedings, which means if at all the order is challenged in an appeals and appeals changes the order, what will happen to such cases? So if at all you see, appeals can either reduce or enhance the order which is given by the adjudicating authority or the lower appeals authority, and that reduction of amount or the enhancement of amount will be the final amount which will be recovered in terms of section 84 read along with rule 161. The problem is when you talk about appeal, giving a final appellate authority or tribunal or high court or supreme court giving that order, giving effect to reduction in amount or enhancement in amount, basically that order cannot be called as an order. It can be called as an intimation or notice. It can be maximum called as intimation or notice. So there will be an intimation or notice for that reduction of amount or enhancement of amount, which will be given in DRC 25. So rather than calling it, naming it as order, they have named it correctly, telling that no, this is basically not an order. The appeals authority or the appellate tribunal or the high court or supreme court has not adjudicated the matter. All they have done is heard into appeals and finally decided the amount. Therefore, that finality cannot be called as an order. It is only telling that okay, this is the appeals order will be there. But for the increased amount or the decreased amount, there is only an intimation or notice telling that this is the final amount which will be now recovered. Right. So appeals order would be received. Now recovery is a result of that. For recovery, there will be no order. It will be either intimation or notice. So you have to understand that appeals authority or appellate tribunal or high court or supreme court will give an order. When the amount is changed, for the amount being changed, recovery will start. For that recovery, there will not be an order, there will be only an intimation. Or now, friends, let us see an interesting circular by CBIC where it talks about your section 75 and its side effects. Basically, what is happening? There is a notice based on fraud. So initially, the notice was issued by the department claiming that it is fraud, right? Intention to evade tax, fraud, willful misstatement, suppression of facts with an intention to evade tax. But appellate authority or appellate tribunal or high court or supreme court concludes that it is not sustainable under section 74 because there is no fraud, there is no intention to evade tax because that has not been established. Now the same notice and order will still be valid, treating it as a notice, deeming it as a notice and order as per section 73. So initially department started the case alleging that it is fraud. So initially department started the case with section 74, and when the matter went into appeals, that is either appellate authority or appellate tribunal or high court or supreme court, they said that the presence of fraud or willful misstatement or suppression of facts and the intention to evade duty has not been established. So now treat this section 74 notice and order as section 73 case. Now what will be the time period for redetermining the final amount? Because when you talk about fraud case, the time period is more, last 4 years, 6 months for notice, right? When you talk about bona fide case, section 73, the time period is less. So when department started the case, basically they have the maximum coverage of 4 years, 6 months notice. And when it is finally redetermined, the coverage can be only of 2 years, 9 months. Now there should be redetermination of that amount. What is the time limit for redetermining that amount? You have to revise the amount. The revision of amount will be there. Now, this is clearly addressed in section 75 subsection 3, where it tells that order is required to be issued because of direction of appellate authority or appellate tribunal or high court or supreme court. That order needs to be given within 2 years from the date of communication, which means after the order of appellate authority or appellate tribunal or high court or supreme court for redetermination. Now, for taking it from section 74 and bringing it in section 73 for redetermination, taking the case out of section 74 and redetermining under section 73 for redetermining, the officer will have 2 years from the date of appeals order. So that is very clear. Now the second part is how to redetermine the amount. Now what is the time limit to determine that amount? 2 years. What is the time limit to redetermine the amount? Initially the notice was of 4 years, 6 months, now it is of 2 years, 9 months. So that is the time limit. After you get that appeals order, you have 2 years time limit to redetermine. You have 2 years time limit to redetermine that case. So that is the first case. Second is how to redetermine. What will be the amount payable when you are redetermining or recomputing as per section 73? Now, this is a very logical answer. If you see this entire crux, what are they trying to tell? The issue is, if at all the notice, will take an extreme case. If at all the notice was served for last 4 years. The notice was served for last 4 years under section 74. The notice was served for last 4 years. 4 years under section 74. Now the appeals have said that no. It is not valid for last 4 years. It is now valid only for 2 years, 9 months. What is the maximum time limit that notice could have been served? 4 years, 6 months. But it has ignored that, and in this specific case, the notice was served for last 4 years. Now the notice is to be treated as section 73 notice because it is held that section 74 in action was invalid. Now you have to go as per section 73. So what will happen? What was the time limit basically? The time limit basically was 4 years, full 4 years, first year, second year, third year and fourth year. So 1, 2, 3 and 4. So initially the coverage was of last 4 years. As per section 74 notice, they were covering the entire 4 years. Now they have to cover last 2.5 years. Last 2.5 years. When I tell last 2.5 years, it is the fourth year, third year, and second year half. And second year half. Initially, the notice was under section 74. Therefore, though the maximum coverage could have been 4 years, 6 months, but assuming that this particular notice was for last 4 years, so the coverage was year 1, year 2, year 3, year 4. Now when it is said that this notice is not valid under section 74 because appeals have said that it is not valid. Appellate authority or appellate tribunal or high court or supreme court said that it is not a fraud case. It has to be treated like bona fide case. Now the recovery cannot be for last 4 years. In this case, though the maximum time is 4 years, 6 months. In this case, the recovery can be only for last 2 years, 9 months. So this 2 years, 9 months is the fourth year, the third year, and the second year half. And obviously, redetermination. Obviously, there will be redetermination for this period, and this redetermination should have been done within 2 years of appeals order. What if I tell that this particular notice, if I change this case a bit, and I tell that the notice was given for only 2 years. So 1, 2, 3, 4, 4.5. So you're talking about first year, second year, third year, fourth year, and the fifth year it is half. Fifth year it is half a year. So the notice could have been given for last 4.5 years, but the notice was given only for first year and second year. In this case, we are going in a reverse order. Initial years. So under section 74, the notice was given only for 2 years, not the last 2 years, initial 2 years. Under section 74. Though the maximum time limit is 4 years, 6 months, they have used the maximum time limit, and the coverage of this notice was initial 2 years. The notice is given now, but it is not covering the entire 4.5 years. It is covering the initial 2 years, not the last 2 years. Initial 2 years. This is a very interesting case. Now it has been held by appeals that this is not valid. It has been held by appeals that this notice under section 74 is not valid. So when it is not valid, you have to treat the case as section 73. And in section 73, what is the maximum coverage that can be there? It can be only 2 years, 9 months. In 74, the maximum coverage can be 4 years, 6 months, which it has used, and it has covered only the first 2 years. It has not covered the entire 4.5 years. It has not covered the last 2 years. It has covered the first 2 years. Now, it cannot be treated as a case of section 74 because appellate authority or appellate tribunal or high court or supreme court said that there is no fraud, no willful misstatement, no suppression of facts. There is no intention to evade duty. Now treat this as a case of section 73. So when you are treating this as a case for section 73 and you are going accordingly, what can be the maximum coverages? The last 2.5 years. Last 2.5 years. By the way, in this scenario, you cannot even proceed under section 73. Why you can't proceed under section 73? Because the notice was pertaining to a period before that 2.5 years. When the notice was given under section 74, it was not talking about the last 2 years. It was talking about the initial 2 years of 4 years, 6 months. Initial 2 years. Initial 2 years of 4 years, 6 months. Let us assume it this way. Why you cannot go under section 73? If in the beginning itself the notice was given under section 73, even in that case, they could not have proceeded because the time limit of last 2.5 years would have 2 years, 9 months would have been gone. In this case, worst scenario, let me make it more clear. The worst scenario, basically the coverage is 2 years, 9 months under section 73. So let me make a small change rather than telling it that it is because there will be 3 months common. It is last initial 2 years. It is initial 1 year 6 months. Initial 1 year 6 months. So when the notice was initially given, it was for first 1.5 years. It was for first 1.5 years. Why I have changed the number? For a very simple reason, that if I take first 2 years and if I go backwards, still that 3 months will be common, and the point that we want to understand will not be fully understood. So it was initial you're talking about 1 year 6 months, initial 1.5 years. Out of that 4 years 6 months, it was initial 1 year 6 months. Now when you're talking about treating it as a case under section 73, what can be the maximum coverages? The last 2 years 9 months, which means you're talking about the last 6 months. Here in the 5th year there are 6 months, and 4th year full year, 3rd year full year, and between your 2nd year and 3rd year we are talking about 3 months. So 2nd year 3 months, then 3rd year full, then 4th year full, then 5th year 6 months. So you're talking about 2nd year 3 months, and 3rd full year, 4th full year, and 5th year 6 months. Now when you see, this case cannot be taken under section 73 for a simple reason that the notice, if at all it was a section 73 notice in the beginning itself, it was not possible to give notice for the initial 1 year 6 months. When you treated that as a case of section 74, it was possible for you to give notice and give order for the first 1 year 6 months. But if you're treating it as a bona fide case, the coverage is only of last 2 years 9 months, which is not common. So 5th year 6 months, 4th year full, 3rd year full, and 2nd year the last 3 months, you could not have covered it. Think this way: if initially itself section 73 notice was to be given, it was not possible to give that notice for the first 1 year 6 months. So that is the concept of this circular. So this circular talks about, if at all a notice and order was initiated against 74 and later on appeals tells that no notice of case will be treated under section 73, what is the time limit for redetermination after the appeals order? 2 years. And how to redetermine? Treat it as a case of section 73, so you have to redetermine that amount accordingly. So that is all about this particular circular. Yes friends, now let us talk about a circular on your IBC, Insolvency and Bankruptcy Code 2016. Already the earlier circular on IBC have clarified that you cannot take coercive action against a corporate debtor with respect to dues which is prior to the commencement of corporate insolvency resolution process. So if there is a corporate debtor and IBC proceedings have started, and your IBC proceeding means your corporate insolvency resolution process has started, the dues before that initiation of corporate insolvency resolution process cannot be forcefully recovered. Such dues will be treated as operational debts, and the claims has to be made by the proper officer before National Company Law Tribunal in accordance with the provisions of IBC. So basically they are trying to tell that you cannot recover it forcefully. So when you are talking about your IBC starting, your process of insolvency and bankruptcy is starting, and there is commencement of corporate insolvency resolution process, and the person will be treated as a distinct person, the corporate debtor, for the recovery of the dues before that initiation of CIRP. Those dues treated as operational debts, proper officer not to recover it by attaching the properties. It has to make an application to NCLT, and that too it will be made after finality. Right. So What is this circular talking about? This circular is talking about how this order of adjudicating authority will work when your IBC process has started with respect to your demand and recovery. So how this both has to be merged, and after the finality by the authorities under IBC, how those dues will be recovered. So what will happen during the process of IBC? It is very simple. And during the process of IBC, any debts, any operational debts before the commencement of your CIRP, that debts cannot be touched by the officer. That has to be submitted by the officer in front of NCLT. And after the finality of the proceedings under IBC, what will happen? So if you see section 84, that section 84 tells that when a notice of demand in respect of tax, penalty, etc. or any other amount called as government dues is served upon a taxable person or any other person, and any appeal revision application is filed or other proceedings are initiated. So whenever there is an order against a taxable person or any other person, and the taxable person has preferred for appeals or revision, or there is any other proceedings initiated, against that government debts, and when that debts are finally reduced, that section continues, and after some time, when you see clause B, when the government dues are reduced in appeals, revision or any other proceedings, commissioner will not give a new notice of demand, because now it is about reduction, not about enhancement. For enhancement, that fresh notice of demand has to be given, not for the reduction. And commissioner will give intimation of such reduction to the appropriate authorities, so that the recovery is only of the reduced amount, not of the original amount. Right? Only the reduced amount would be finally recovered. Now understand that this entire section 84 is telling that whenever there is an amount which is due by SSC, and SSC has preferred appeals or revision, or there is any other proceedings, Now we have to understand the meaning of any other proceedings. The word other proceedings is not at all defined in GST Act. Right? When you talk about adjudicating authorities and appellate authorities under IBC are quasi-judicial authorities, where they are dealing with civil disputes pertaining to insolvency and bankruptcy, and proceedings conducted under IBC can be treated as any other proceedings. That term, any other proceedings, covers the proceedings under IBC, simple language. The term, any other proceedings, which is used in section 84, covers your IBC proceedings because they are quasi-judicial bodies. And that being the case, if at all your IBC proceedings has reduced the amount, proceedings has reduced the amount, for that reduction amount, no fresh notice will be given. Commissioner will tell that reduced amount to the tax authorities, and recovery will be done only of the reduced amount, only of the reduced amount. So if your IBC proceedings finally tells that no, this is not the amount that can be paid, because NCLT has said that this person is not having such amount, so only this much amount can be paid to you. So that is a reduced amount that is set by your IBC. For that reduced amount, commissioner will not give a new notice of demand, because already that order is there. But commissioner will intimate the respective authorities, telling that recovery will be only of that reduced amount, and recovery proceedings will be again started. Whenever there is a finality under IBC, recovery proceedings will start, but recovery proceedings will be only of the reduced amount. So there are few things that you need to understand. First thing you need to understand is, whenever a person is going through the process of IBC, the initial thing that you need to understand is, before the start of any dues, before the start of CIRP, that is corporate insolvency resolution process, they will become operational debt, and those dues cannot be recovered then. When those dues will be recovered? Only after finalization, those dues can be recovered. And it is highly possible that at the time of finalization, the dues are reduced by your IBC proceedings, which is quite normal, which will be finally the dues will be put in front of National Company Law Tribunal. Highly possible because the person is insolvent, the dues will be reduced. So finally, the dues are reduced only after finality. One thing, during the proceedings, there cannot be forceful recovery. After finalization, there will be forceful recovery, and it will be of the reduced amount as finalized by your insolvency and bankruptcy court. So if at all you want to make your life simple, the summary of the circular is quite simple. The proceedings are going on, don't recover. When the proceedings are finalized under IBC, recovery will start, but not for the original amount. It will be starting for the only reduced amount which is finalized by your IBC proceedings. Yes, friends, now you're talking about your refund claim by unregistered person. So even an unregistered person can claim refund in terms of your Rule 89 2KA, and he has to give certain documents which are given not only in Rule 89 2KA but also given in Rule 89 2KB, and there's a point which is given in proviso to your Rule 89 2M that there is no need of CACWA certificate for such claim by unregistered person. Basically, our entire focus is on what? We are talking about refund claim not by the supplier, the refund claim which is made by the unregistered recipient, refund by the unregistered recipient, where the agreement or contract is that of supply of service and it has been terminated. So please understand that there are two scenarios. One, refund claim is by unregistered person, recipient. The contract is of supply of services and that contract has been terminated. So you're talking about a refund by unregistered recipient. Second, the contract is that of supply of service. Third, you're talking about that contract or agreement which was of supply of service has been terminated. In that case, what all documents needs to be submitted for refund by that unregistered recipient? A statement containing the details of invoice, be it the invoice number, date, value, tax paid, etc., etc. Copy of such invoices. One is the statement containing the list of all such invoices. Second is a copy of such invoices, and third is the proof of payment to that supplier. And next is the copy of agreement which was there with the supplier of service. And finally, that contract which is cancelled, there will be a letter given by the supplier for cancellation or termination of that agreement. And in the event of cancellation or termination of that agreement, the supplier would have paid back the amount. Supplier would have paid back the amount. So payment received by such unregistered recipient from the supplier. So basically, you're talking about your statement of invoices, copy of invoices, payment made to that supplier, agreement entered at the beginning, and cancellation letter. And finally, along with that cancellation letter, you have to give the proof that upon cancellation you received that amount. You received back that particular amount, but not the GST portion. Now, basically, in addition to all these documentation, even one more document will be required. A certificate needs to be given by the supplier telling that he has not adjusted that amount of tax for which he has given the refund, either by way of giving credit note, or nor he has claimed any refund, nor he is going to claim any refund for which the refund claim is made by the unregistered recipient. Basically, you're talking about what? What is the situation covered here? The situation covered here is there was an agreement of supply of service. So initially there is an agreement or contract of supply of services. Say for example that agreement is for 10 lakhs plus 1,80,000, which the recipient has paid to the supplier. This is very common in your real estate contracts. So even the circular which is explaining this provision talks about real estate contracts. So there was an agreement For what? There was an agreement for supply of service, and the amount was say 10 lakh plus GST. Finally, after partial work, for some reasons, say for example, it is a case where the work is not completed, therefore there is an entire refund, or the work is partially completed and therefore there is a partial refund. Right. So initially the payment was made for such. There was such agreement for supply of services. There was such agreement for supply of services by the supplier to the recipient, for which recipient paid an amount of 10 lakh plus GST at 18 percentage. Let us assume that GST is at 18 percentage, 1,80,000. At a later point of time, this contract is terminated. So there is a letter for termination of contract or the agreement. So why this termination is happening? It could be a scenario. It could be a scenario where the work is partially done, or where the work is not at all done. So within the stipulated period. Now there is a refund. Let us assume a scenario where there is a partial refund of 4 lakhs. But along with this 4 lakhs, GST is not being paid. Along with this 4 lakhs, GST is not being paid. Rather, let us first assume, understand that it can be possible for the entire contract. Let us assume that the contract fully is cancelled because the builder was not in a position to execute the work in full, and he has given the refund. Now, when he is giving the refund, is giving only of 10 lakh. He is not giving the GST portion. Understand that supplier has already paid output tax to the government. Now he is not in a position to reverse the output tax because he cannot give a credit note. The time limit for issuing credit note has lapsed. The time limit for issuing or giving the credit note has lapsed. Therefore, he is not in a position to reverse the output tax. So when he is giving the refund, when he received the amount, what was the amount which was received? 10 lakhs plus GST. But when he is giving the refund, he is able to give only 10 lakhs, not the GST portion. Now, the point is, now if you look at the case, it is classically covering all this case. Now, who is claiming the refund? Who is claiming the refund? It is by unregistered recipient. Because when you're talking about a recipient, he should be unregistered person. If he is registered, he would have taken the credit. So here, condition number 1, the refund claim is by unregistered recipient. Second, the contract is that of supply of services. Third, that contract has been terminated or cancelled. So criteria number 1, refund claim is by unregistered recipient for supply of services where that contract or agreement of supply of services has been terminated. Now, if you look at this entire example, you clearly understand what is the problem. Supplier has already paid the output tax. Recipient did not claim the credit because he is not registered. Supplier is not in a position. Supplier has paid tax, but recipient no ITC because he is not registered. Supplier is not in a position to reverse the output tax because he cannot give the credit note. Time limit for credit note is lapsed because it is a long contract. Long contract, the time limit for giving credit note is lapsed. Also, supplier promises that he is not going to claim the refund. Now, understand that when all these 3 criteria are satisfied, recipient, the unregistered recipient for the supply of services where the contract is terminated can apply for refund. When it is applying for refund, what all documents it has to submit? It has to submit the statement of invoices, copy of invoices, statement in Excel sheet of invoices, the copy of invoices, the agreement which was there for supply of services, and rather it has to give the, along with the copy of invoices, it has to give the proof that it has made the payment. Proof of payment to the supplier. In addition to it, it has to give the agreement for the supply of services, it has to give a proof or the letter of termination of that agreement or contract by the supplier and prove that it has received the amount from supplier. But when it paid the amount to the supplier, it was amount plus GST. When it has received back the amount, it has received only the amount and not the GST portion. Not the GST portion. And supplier to give a certificate that it has not given any credit note and it is not going to apply for refund. Neither it has applied or nor it is going to apply for refund. So these all proofs needs to be submitted. All these proofs needs to be submitted. And this is refund claim by your unregistered recipient. Unregistered recipient. If you look at the scenario and the documentation, you will clearly understand what is exactly happening. Now, the circular exactly explains whatever we have discussed, and the circular discusses certain basic issues. Whether on the portal you have a new functionality, yes, the portal now allows the unregistered person to claim the refund under the category of refund by unregistered person. Now, certain interesting questions comes up. When you're talking about unregistered person making refund claim, how is going to make a refund claim? Because he is not registered. This unregistered person has to obtain a temporary registration in the state in which supplier is there. And if the supplier has given invoices and the supplier is there in different states, the unregistered recipient has to take temporary registration in each of that state. And this refund application should be made for each of the suppliers. It is supplier wise. Supposing I am the recipient where this scenario is happening and I am making the refund application and I have entered into contract with 3 of such suppliers. So for each of the suppliers, there's a separate refund claim. First, you need to understand that is there an option that unregistered person recipient can claim the refund? Yes, there is an option on the portal. Alright, this option on the portal tells that in the GST RFD01 form, the documents can be submitted along with the application. What the recipient has to do? The unregistered recipient has to obtain temporary registration in the state where the supplier is registered. If the supplier has given invoices where it is there in multiple states, recipient has to register in each of the multiple states. Whether it has to give a combined refund application pertaining to all such suppliers? No. For each of such suppliers, separate refund application has to be made. Now understand that the refund claim is only by unregistered person. And supplier is not in a position to give credit note. At the time of cancellation, the time limit for giving credit note is gone. Otherwise, supplier would have given credit note. So there's no possibility of giving that credit note. So supplier is not in a position to give credit note. If supplier was in a position to give credit note, there's no need of any refund. And what all documents have to be submitted, we have discussed. Now the question is, what is the relevant date for the unregistered recipient? Basically, first we have discussed what are the process of claiming the refund by this unregistered recipient. Now we are talking about what is the relevant date for that unregistered recipient. Basically, if you see, whenever refund is claimed by any other person apart from the supplier, whenever there is a refund of a person by a person other than supplier, the relevant date, that is 2 years for making refund application, starts from the date of receipt of goods or services. But in this case, you need to understand that there was no receipt of service. You're not talking about goods. There was no receipt of service because the agreement or the contract for receipt of services cancelled. To the extent of which it has not been made, there's no receipt of service. See, for that portion which has not been supplied, either the entire agreement is cancelled or part of the agreement is cancelled. To the extent of cancellation only we are discussing. So for that extent of cancellation, there was no receipt of services. So now 2 years cannot be taken from the date of receipt of services or goods because for the cancellation portion, there is no receipt of services. So logically, this 2 years will be taken as 2 years from the date of letter of cancellation, as there cannot be any date of receipt of service. So strictly speaking, the 2 years time limit starts from the date of receipt of goods or services. Here we focus is only on service. Now 2 years from the date of receipt of services is not workable because we are talking about refund by unregistered person because of cancellation of contract for supply of service. To the extent of cancellation of contract, there cannot be any receipt of service. Now logically, 2 years from the date of receipt of service has to be read as 2 years from the date of letter of cancellation of contract. Right, so that is the relevant date. And what about the refund amount? The last part. You need to understand refund amount cannot be claimed if the amount is less than 1000 rupees. And the refund amount cannot be more than the tax amount charged by the supplier. It cannot be more than the tax amount charged by the supplier. In case where amount paid by the supplier to unregistered recipient is less than the amount which was initially paid by that person to the supplier. If supplier is not refunding the entire amount, refund is only limited to the proportionate calculation of the amount paid back by the supplier to the recipient. Which means in our example, if the refund was not of 10 lakhs, if the refund was only of 4 lakhs, the refund was not of 10 lakhs, if the refund was only of 4 lakhs because part of the contract was fulfilled and part was not fulfilled, then you're not going to claim the refund of 1,80,000. You're going to claim the refund of the total tax amount is 1,80,000, and what amount is refunded back by the supplier is 4 lakhs out of total amount 10 lakhs. So proportionate calculation. The refund amount will be total tax for the entire supply of 10 lakhs is 1,80,000, and what amount is refunded back by the supplier is only 4 lakhs. Only to that extent refund will be given. That needs to be clearly understood. Proportionate calculation. If the supplier is giving the entire refund of 10 lakhs, then the entire 1,80,000 will be refunded back by the government. If supplier is giving only 4 lakhs, so the total tax amount was 1,80,000 for entire 10 lakhs. The refund amount for 4 lakhs will be 1,80,000 divided by 10 lakhs multiplied by 4 lakhs. You have to use your calculator and get that answer. So that's all about refund claim by unregistered recipient. We have discussed when it gets activated. We have also discussed what all documents need to be supplied. In the list of documents, you need to understand that there is no need of CA/CWA certificate irrespective of value. There's no, all these other documents or proofs needs to be submitted that we have discussed, but there's no need of CA/CWA certificate irrespective of the value. So that needs to be clearly understood. Yes, friends, now let us discuss your amendment in appeals and revision. Basically, very limited amendments in your appeals and revision for your November 23 exams. One amendment is there in your Rule 108, which is appeals by SSC to appellate authority. And then there is an amendment in Rule 109, which is appeals by department to the same appellate authority, that is first level. And then you have 109C, that is withdrawal of appeals in the first level appellate authority, basically by SSC or by department. And if you see all these amendments, they are only talking about the first appeals, appellate authority. So 108, 109, 109C is a new rule added for withdrawal of appeals, and all these rules, whatever you are going to discuss, are effective from 26th of December 2022. Now let us understand what has happened in your Rule 108 and 109, where you are talking about appeals by SSC to appellate authority, why that rule has been fully changed, and appeals or application by department, rather the right term is application by department to appellate authority. Now what has happened is they have removed the concept of submitting the self-certified order copy. In both the cases, actually the amendment is quite similar, both in 108 and 109. The burden of submitting the certified copy of order. So what all order is online. Then again, while filing the appeals, I was required to submit the certified copy of the order, which was not required because order itself was online. So that is now removed. If you see in both the places, if at all the order is online, I need not submit the certified copy of order because order itself is online. What I can do, self-certified order copy are sufficient. I can submit the same order copy, I can self-certify it. Now, let us understand this rules in toto. Let us also understand when you talk about orders of officer, the orders of the officer can be online on common portal or manual, which is there on common portal or manual. So assessee is getting an order of adjudicating authority. It can be online or manual. Now, understand that if the order is against the assessee is going to file an appeals to appellate authority. If it is against the department may file an application to the appellate authority. So we are discussing both your rule 108 appeals by assessee to appellate authority and rule 109 application by department to appellate authority. So one case we are talking about assessee and the other case we are talking about department. In both the cases we are talking about they are going to the first level appellate authority, and both the concepts are quite similar. So when the order is online, we are trying to understand what you do when you're filing the order online. Please understand that when assessee is filing the appeals, it is in form APL01 and for department it is APL03. Appeals 1 form and appeals 3 form. So whenever assessee is filing an appeal or department is filing appeal, the appeal form varies but the concept remains the same. If at all there is an order which is online on the common portal and against which appeals is being filed, against which appeals by assessee or application by department is being filed, you will get an acknowledgement. There's something called as a provisional acknowledgement. The moment you file an appeal, you'll get a provisional acknowledgement. You'll get a provisional acknowledgement, and after he files, when it is acknowledged, there will be final acknowledgement. So there is something called as provisional acknowledgement, final acknowledgement. Now the date of filing of appeals or application will be the date of provisional acknowledgement. The date of your provisional acknowledgement. Now what is the difference? If at all you are having an order which is online and now you are filing your appeals by assessee or application by department, first you will get a provisional acknowledgement immediately, and thereafter when everything is verified, then you will get a final acknowledgement. Now the date of filing of appeals, date of filing of appeals will always be date of provisional acknowledgement in the first case. Now also understand that the amendment tells now that you are not required to submit certified copy of order. There is no requirement to submit the certified copy of order. A very logical point for a very simple reason being that order itself is online. Now, if the order is manual, then assessee will file appeals and department will file application to appellate authority. In that case, again, the concept remains the same. There will be provisional acknowledgement given initially in APL02, then there will be final acknowledgement. Now, in that case, after you get provisional acknowledgement, you have to submit the certified copy of order. Within 7 days of provisional acknowledgement. So when you file the appeals, you get a provisional acknowledgement. Now understand that if the order itself is online, they have removed the need of submitting certified copy of order because order itself is online. But when the order is manual, there is still a need of submitting certified copy of order. Quite logical. because the order was manual, and that has to be submitted. First, you have to file appeals by SSC application by department. You'll get a provision acknowledgement. Then within 7 days of provision acknowledgement, you have to submit the certified copy of your original order. Now understand that what is your date of filing of appeals. If that certified copy of order is submitted within 7 days, if that submission is within 7 days, if the submission is not within 7 days, what submission we are talking about? Certified copy of order to be submitted after provision acknowledgement. So you have to submit what? You are required to submit your certified copy of order within 7 days of provisional assessment. Did you submit within 7 days? If you have submitted within 7 days, then your date of filing of appeals will be nothing but date of provisional acknowledgement. So this date will be treated as date of filing of appeals. But as the order was manual, you are required to submit the certified copy of order within 7 days of provisional acknowledgement, and you did not submit within 7 days. In that case, your date of filing of appeals will be date of submission of certified copy of order. So you need to understand that if at all the order happens to be online, there is no requirement to submit the certified copy of order. There's no requirement of submitting the certified copy of order. Absolutely no requirement of submitting the certified copy of order. Logical as well. And the date of filing of appeals by SSC or application by department would be the date of provisional acknowledgement. If at all the order happens to be manual, then there is a need to submit the certified copy of order within 7 days of provisional acknowledgement. You have to submit whenever SSC files appeals or department files application within 7 days of, they'll get provisional acknowledgement. Within 7 days of provisional acknowledgement, certified copy of order needs to be submitted. If at all it is submitted within 7 days, then the date of filing of appeals is the date of provisional acknowledgement. If it is not submitted within 7 days, then the date of filing of appeals is date of submission of certified copy of order. The amendment which has been brought out both in Rule 108 and 109 is removal of concept of submission of certified copy of order in case the order was online. So that's the amendment which has been brought out in your Rule 108, appeals by SSC to appellate authority, and Rule 109, application by department to appellate authority. Now friends, a new concept is introduced called as Rule 109C. Now what is this Rule 109C? Earlier, when appeals is filed by the SSC to appellate authority or application is filed by the department to appellate authority, there was no concept of withdrawal. You cannot withdraw. But now the appeals can be withdrawn. The appellant, which means you're talking about whether the SSC or the department, at any time before the issuance of show cause notice under section 107 subsection 11, or before the issuance of order under the same subsection, whichever is earlier. So you have to understand that whether the appellant is SSC or the department, they have to withdraw their application before the issuance of notice or before the issuance of order, whichever is earlier. And whenever you talk about SSC going for appeals, it is APL 01, department APL 02, APL 03. APL 02 is provisional acknowledgement. SSC going is APL 01, department going is APL 03, and that application can be withdrawn by the SSC in APL 01W, by the department in APL 03W. W stands for withdrawal. So both SSC as well as the department, after they have filed the appeals, they can withdraw the appeals by SSC or application by department. But in case where final acknowledgement is finally given, when the final acknowledgement is given in APL 02, when you get the final acknowledgement, It is all possible before final acknowledgement. The moment you get final acknowledgement, withdrawal will be possible only with the approval of the appellate authority, which means there's one case where withdrawal is automatic, you can withdraw. In the second case, if at all final acknowledgement is given, then withdrawal is possible but only with the approval of appellate authority, and you have to make an application for withdrawal which has to be decided by appellate authority within 7 days of application. So separate application needs to be made. Also understand that if at all after withdrawal you have to file fresh appeals, then that should be within the original time limit. There is no such extension. There's no such extension. So is it possible to file an appeal again after withdrawal? Yes, that is possible. But there's no extension of time limit. It is within the original time limit. So here, the first concept you're talking about automatic withdrawal. Automatic withdrawal. By SSC, appeals by SSC or application by department. The second concept you're talking about withdrawal, but this is with the approval of appellate authority, and which has to decide within 7 days. In the first case, there is no such application. There is no application made for withdrawal. In the second case, you will file an application basically, but that application is not decided. So in both the cases, there is an application, APL01W or APL03W, but it is automatic. In the both the case, application will be, but it is automatic. In the second case, there you have to go and take the approval of appellate authority. Now, understand that the first case is possible when you're talking about before issuance of final acknowledgement. In the second case, there is final acknowledgement which is given, and after that, the only chance of withdrawal is approval of the appellate authority. And when you file that application APL01W and or APL03W by SSC or by department respectively, within 7 days, appellate authority has to decide whether it can be withdrawn or not. Can you refile appeals after withdrawal? Is it possible to refile appeals after withdrawal? So again, you're talking about the concept of refiling of appeals after withdrawal. Yes, it is possible, but they have clarified that withdrawal, after withdrawal also refiling of appeals is possible, but within the original time limit, there is no extension. There is no extension whatsoever. So this is a new concept that has been introduced this time in form of Rule 109C. And understand that all the amendments that you've discussed here, be it 108 or 109 or the new Rule 109C, all are effective from 26th of December 2022, and all are at first levels, appeals at appellate authority, whether by C or by department. Friends, now let us discuss the miscellaneous provisions amendment. Basically, the amendment has come only in anti-profiteering measure, that is in section 171, and the constitutional amendments have come in your Rule 122, which is omitted, 124 omitted, 125 omitted, 127 there's a change, the term duty is substituted by functions, 134 is omitted, 137 is omitted. Now, what is the amendment that has come in your anti-profiteering measure? That's actually a 1-point amendment. Now, your Competition Commission of India, CCI, will be empowered as anti-profiteering authority. Under your Competition Act, there is Competition Commission of India, that is empowered as your anti-profiteering authority. The moment it is empowered as anti-profiteering authority, then there is no need of what is that authority? There is no need of constitution of authority. So Rule 122 is removed. There's no need of appointment, salary, etc. because it is already there for Constitution Commission of India. So that is removed. There is no need of secretary to the authority, Rule 125. That is removed. There is no need of the point that decisions are to be taken by majority. Per se, that is the same thing in Competition Commission of India. So that is removed. There's no need of tenure of authority. CCI, even after it is not taking care of anti-profiteering clause, it will still take care of your Competition Act. So there's no need of tenure of authority, that is removed. And another changes in Rule 127. Now the term duty is substituted by functions. What are the functions? Rather than calling it as duty, now they are preferring it as calling as functions. And even in its explanation to chapter 15, now authority does not means national anti-profiteering authority, because now that is not there. Authority means an authority notified under section 171 subsection 2, which is now Competition Commission of India. So what is the amendment that has come in section 171 and the related provisions? Now the authority which is going to take care of your anti-profiteering measure is your Competition Commission of India, and therefore certain rules which are not allowed have been removed, and in one rule the term duty has been substituted by function, and in explanation it is said that authority does not means your national anti-profiteering authority. It now means an authority as per section 171, which basically is nothing but Competition Commission of India. So this amendment is with effect from your 26th of December 2022.